I'm here in New York City on this Tuesday morning. Welcome to Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. I'm Brad Smith alongside Josh Lipton this morning. Let's get to the three things that you need to know.
And first up, stock futures are muted after a winning start to the shortened holiday week. Tech and chip stocks leading the way, pushing the Nasdaq up around 1% Monday. Equity markets close, remember, at 1 p.m. Eastern today due to the Christmas holiday. Investors tracking the first day of the so-called Santa Claus rally, the last 5 trading days of December and first 2 of January that historically bring a market rally.
Plus, some holiday travel turmoil. American Airlines briefly grounded all flights nationwide earlier today due to a technical issue. The FAA lifting the ground stop just over an hour ago. In a statement, American says a vendor technology issue briefly affected flights this morning. That issue has been resolved and flights have resumed. Shares initially fell more than 5% on the news. They've since recovered most of those losses. This comes, of course, during a busy travel holiday week. TSA expects to screen nearly 40 million people from December 19th through January 2nd.
And President Biden is set to decide the fate of Nippon Steel's $15 billion bid for U.S. Steel. The Committee on Foreign Investment in the U.S., or CFIUS, referred the deal to Biden Monday after failing to reach a consensus. CFIUS was reviewing the acquisition for national security risks. The president now has 15 days to review the deal, which he has long opposed and is expected to block U.S. Steel, calling on Biden to do the right thing and approve the transaction.
We're taking a look at stock futures on this holiday shortened trading week. You've got a good look at the Dow here, just inside of 30 minutes to the start of trade, flat just barely to the downside. The S&P 500, that's up by about 0.2% in futures, and the Nasdaq futures, you're seeing that point higher by about 0.4% here as well. And a quick look at the bond markets, taking a brief gander at treasuries here, you're seeing some fractional moves higher across the 5, the 10, and the 30-year yields as well.
And taking a look at Bitcoin ticking higher this morning. Of course, pull back the chart. Listen, this has been a stellar year for Bitcoin. If you owe Bitcoin, Brad, you're a Christmas dinner, you're doing a victory lap, let's be honest. You know, part of that also, of course, Trump winning the election and positioning himself as a crypto friend and ally. We know recently there has been some weakness there. That is probably reflecting some expectation the Fed won't be cutting rates next year as expected. Also, let's take a look at the Mag 7, those big tech names. You can see it's kind of mixed here. Nvidia, Tesla, Apple in the green, Microsoft dipping a bit here, Google, Meta, and Amazon also in the green. Of course, we know, listen, Mag 7, it's been the place to be. There's different reasons for that. One reason, of course, is that there's a lot of uncertainty right now, uncertainty about the economy, the Fed, Washington, Trump. When that happens, people tend to get more defensive, and those big cap tech names can be one place you look with obviously strong balance sheets, tons of cash.
Absolutely. As we mentioned, it's a short week due to the Christmas holiday. Markets close at 1 p.m. today. Bond market closes at 2 p.m. All markets are closed on Christmas Day, and we'll be back here right on Yahoo Finance Thursday and Friday with some fresh data out as well. There you're taking a look at the expectations, of course, as we had gotten consumer confidence to kick off the week yesterday. We're still going to get initial jobless claims Thursday, and then, of course, once we get to Friday, we'll get some of the advanced retail inventories and wholesale inventories as well. So an important note we should also mention today is the start of the so-called Santa Claus rally. Now, historically, we have seen gains in the last 5 trading sessions of December through the first 2 trading sessions of January. So we'll see how that holds up this week. It all goes down, or at least commences here today, Josh.
Got it.
A developing story that we're following this morning, American Airlines resuming operations after grounding all flights nationwide due to a technical issue that impacted systems needed to release flights. Now, the ground stop lasted for about an hour, and this coming on one of the busiest travel days of the year with a record number of Americans traveling this holiday season. There you're taking a look at shares of American Airlines, ticker symbol AALs, down right now by about 0.75%. And we mentioned the significance of this on this particular travel day, even as we do have now flights beginning to resume and beginning to take back to the air. To this point in the year, TSA has already screened 5% more than they have in 2023, which was a record year for air travel and for the passengers that took to the skies here in the U.S. And we should also note that that amounts to about 41 million more travelers screened before this week even started. And so you kind of pair that with also what we're expecting to see over the course of this week, where they're looking for about 40 million more travelers to take to the skies here.
Yeah, there was a statement by American Airlines, by the way, just a statement on X they put out, Brad, saying your safety is our utmost priority. Once this is rectified, we'll have you safely on your way to your destination. I didn't see a lot more background on what exactly the issue was yet.
Yeah.
I did see some reports out there. Maybe they were dealing with some type of software outage, preventing them from calculating weights and balance requirements for their flights, but still looking for some more color and commentary. As you noted, I mean, a terrible day for obviously this to happen. Obviously, everybody's on the taken to the airports, trying to get home, holidays, friends and family. Not good timing at all.
Yeah, and the huge thing too for investors to think about with this, and perhaps where some of the mindset went early on within the investor sentiment, is trying to make sure that this wasn't a CrowdStrike-like issue. That was the larger pullback that we had seen pre-market. However, we've paired a lot of those losses here, still down fractionally, but as long as it is not that comes to light, which certainly had impacted Delta Airlines, had impacted so many of the other airlines during the summer, I think that eases some of the concerns for investors, and now we're only seeing some fractional declines from
Yeah, it was a tough headline to start, but listen, good year for this stock. As we wrap up 2024, this one's up around 25%.
Yeah.
All right, we move on. Tech stocks helping markets begin the holiday shortened week on the right note as investors hoping for a Santa Claus rally to wrap up a year of records. But what might the next year bring to the public and private markets? Scott Sperling, Thomas H. Lee Partners co-CEO, joins us to discuss it all. Scott, it is great to see you and have you on the show. So maybe, Scott,
great to see you. Happy holidays
to you as well, sir. Maybe to start, just bigger picture. Interested, Scott, to get your thoughts on this stock market. Talking to Brad there. Listen, you pull back the chart. We look at 2024. It has been just a stellar move for the stock market, for the S&P 500. That's, of course, on top of a great move, Scott, in 2023 too. As you look ahead to 2025, I'm curious, Scott, to get your thoughts there. We have plenty of bulls come on Yahoo Finance, Scott, and they'll say, listen, the economy's growing, earnings are growing, Trump moving into the White House, that means pro-business, pro-growth policies. What's not to like? What do you say to that, Scott?
So I tend to agree and be a little bit more bullish about next year. I believe that the deregulatory movement of this new administration is going to continue to have a very significant impact that reduces the cost of doing business in this country and provides further stimulus for people to bring manufacturing back to the United States. Although I will say that's a trend that has started over the course of the last 18 to 24 months in a more rapid way. That means significantly more investment in some of the real high technology areas that we need to have more of in this country, particularly the types of semiconductor fab facilities that do the most cutting edge types of work. And so that's all a big positive. We've seen the movement of the overall market and the overall economy towards higher technology, much faster growing, better business model types of companies. Those are all the positive things. I think on the side to be wary about is the consumer has been magnificent for a long time now. First, it was all the money that they were given and all the money that they saved during COVID. That's been gone for quite a while. Credit statistics will show you that the consumer is stretched about as much as they ever have been, and default rates are starting to increase. So I think a little wariness is due here, because it's just not generally up forever. Although when one looks at the last 3 years, anyone who's predicted caution has been proven not to be right, at least in the short term. I do think that one of the things that we're going to have to look at is seeing the benefits of all of this technology investment. I think it's going to be there, but I think we may have to be more patient than the market is generally used to. It is not clear yet how immediate the impact is of the tens and what will probably be hundreds of billions of dollars spent to support generative AI. long term, that's going to have an enormous impact on the productivity of the country and be a net significant positive. Near term, the dollars are being spent well in advance of when we may see some payback. And that may impact the way the market prices companies, at least over the course of the next 12 to 24 months.
Sure.
The last thing I think we need to be wary about is the fact that we have deficits that continue to be at levels that no one could have imagined even 5 or years ago, let alone 10 or 20 years ago.
Right.
We have built up our national debt to levels that are way past nose bleeding territory. And we don't yet have any real clear path to solving that problem, though I am encouraged by the fact that you have somebody like Elon Musk who has done really remarkable things in terms of providing services, and particularly if you look at SpaceX, being able to break a cost curve that always seemed to be going up to provide something that we had always thought only the government can provide.
Sure.
So I have some level of optimism there, but I think caution is due, and that caution will manifest itself in interest rate levels that are probably higher than even the Fed wants. I don't think the Fed will have full control over time of interest rates, as we need to refinance 36 to 40 to 50 trillion dollars worth of U.S. government debt.
Scott,
that's a lot in one sentence.
So I want to pick, and I appreciate the detail level and kind of the pillars that you laid out here, the optimism, the pessimism, and then I'll put Musk as his own pillar. We'll come back to that in a hot second here. But as you're thinking about it, and I want to give investors some actionable tips here, as you're thinking about which names those tech investments would prompt you to pile further into, which names come to top of mind for you?
Well, I know there's been some choppiness in Nvidia recently, but clearly they are the mainstay of everything generative AI, and you're not going to build more capacity to provide advances in generative AI without their technology and without their products. So, that is a name that comes to mind. I think there are real plays in lots of different areas, and you're seeing a lot of investment on the private equity side in companies that help enable the generative AI and all the data processing and all the energy that's needed to occur. So the infrastructure around the sorts of things that will result in the ability to provide cutting edge generative AI products and services to the market is something to look for and to invest in.
I'm curious, Scott, as you kind of look for opportunities, pull out your shopping list, how do valuations generally look?
Well, valuations have been rich, incredibly rich. So one can look at the growth and the expected growth, but you have to recognize that this is one of the all-time most expensive markets. If you look at the Buffett index, we're kind of in again, triple red territory. And I do respect the fact that Berkshire Hathaway has pulled significant dollars out of the market, hundreds of billions of dollars of stocks that they've cashed in. And I think that reflects some of the valuation metrics that we've seen. If you look at other common metrics, we're somewhere around the 96th percentile of heavy valuation relative to our long-term averages. If you look at just the technical of it, mean reversion is something that you're seeing a lot of investment banking and other strategists and tacticians talk about. And if you believe in mean reversion, for the next 10 years, they're predicting anywhere from 0 to 5% annual increases in the stock market. So it's not that all of the phenomenal things that we're looking at in the market has been unfairly valued from in terms of being valued too low. The question is it being valued reasonably fairly, or is it just really at levels that are going to take a very long time? It's going to take a very long time to grow into.
Scott, thanks so much for taking the time here with us this morning, and happy holidays to you.
Happy holidays to you. Take care.
You too. President Biden is set to decide the fate of Nippon Steel's $15 billion bid for U.S. Steel. The Committee on Foreign Investment in the U.S., or CFIUS, referred the deal to Biden Monday after failing to reach a consensus. The president now has 15 days to review the deal, which he has long opposed here. And noteworthy here for CFIUS and their particular role within this, I mean, it's been well regarded, or at least talked about for years, the type of restraint that this agency has showed. Really only 7 deals or transactions that it has prompted presidents to block over the, 50 years since it's been created. So this is extremely noteworthy and perhaps even more precedent setting going into the Trump administration.
Yeah, and this one too, Brad, it just got caught up in these kind of just bigger, broader political and economic forces and trends, right? Just the, as we were just talking here with Scott Sperling about, this focus on rebuilding American manufacturing sector. Of course, then on the campaign trail, Pennsylvania, key battleground state, right? Biden and Trump trying to woo those steel workers. So Biden opposed it. Trump just recently again came out on Truth Social. He opposed it. How did the actual steel workers feel from the steel workers union? They gave a statement to the AP, Brad, said our union has been calling for strict government scrutiny of the sale since it was announced. Now it's up to President Biden to determine the best path forward. They go on to say, we continue to believe that means keeping U.S. steel domestically owned and operated.
Yeah, one of the rare things that President Biden and President-elect Trump agree on in blocking.
Very few things noteworthy when they do, I think we could say, Brad. All right, inflation has been one of the top concerns for the U.S. economy in 2024, we know, and it looks like fears over sticky prices will continue in 2025. Joining us now is Yahoo Finance's Alexandra Canal. Allie.
Hi, Josh. Yeah, the future of inflation next year largely depends on who you ask. The Federal Reserve sees core PCE inflation hitting 2.5% in 2025 before slowing to 2.2% in 2026 and finally reaching that 2% target in 2027. Consensus estimates, though, they're a little less optimistic. According to the 58 economists surveyed by Bloomberg, core PCE is expected to reach 2.5% next year, but less of a deceleration is expected in 2026, with most economists seeing inflation settling at around 2.4%. Now, a big reason for that lies within the future of economic policies implemented by President-elect Trump when it comes to tariffs on China and other trading partners, along with curves on immigration and tax cuts for corporations. All of those policies have been viewed as potentially inflationary by economists. Now, there are some who are certainly more bearish than others. Nobel Prize winner Joseph Stiglitz falls in that camp. Here's what he had to say at our Yahoo Finance Invest conference earlier this fall.
We are in the soft landing, but it ends on January 20th. And that's when we start getting into a harder place where we don't actually know where we're going to go. That uncertainty, by the way, is not good for the economy.
So he believes the U.S. economy could fall into something he's described as an inflationary spiral, potentially leading to a tit-for-tat trade war, which would significantly weigh on growth. BNP, meanwhile, it's one firm who issued a grim 2025 global outlook due to, quote, a substantial rise in inflation from late 2025 into 2026 amid the rollout of those tariffs. BNP sees CPI settling at 2.9% by the end of next year before climbing to 3.9% by the end of 2026. It does not anticipate any Fed rate cuts next year as a result. So zero easing expected. Deutsche Bank is another firm that also shares that view. Others on Wall Street see between 2 and 3 cuts, so more aligned with the Fed. But I spoke with a lot of economists for this story, and it seems to be so much uncertainty. There are so many different scenarios when it comes to how tariffs could be rolled out. Clearly, this is something that the Federal Reserve is watching incredibly closely, especially since we've seen sticky prices in recent months. Shelter being one of the most notable, one of the most significant areas when it comes to those high prices. That is expected to decelerate over the course of next year, but still could remain somewhat elevated. The services economy also anticipated to remain hot. So think services like insurance, airfares, healthcare. So if you're a U.S. consumer, it's quite possible you won't see much relief. But the encouraging thing here is that the economy has remained incredibly resilient. Growth is still strong. Consumers are still spending. The unemployment rate remains low, so still a good backdrop heading into next year, if nothing else. And that's something that economists can agree on. So a lot of possible directions and certainly a lot of things to watch in 2025.
Absolutely. We'll be here spectating and analyzing all of it. Allie, thanks so much for taking the time. Appreciate it. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, You'll want to bust out the milk and cookies while you watch our chart of the day. We'll discuss that and much more on Morning Brief. Welcome back. You're watching the Morning Brief brought to you by Invesco. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk a little Taiwan Semiconductor. Pulling back after touching a record high, the stock on track for its best year since 1999. Where were you when? Amid continued enthusiasm for AI. Shares here under a little bit of pressure here in extended hours, down by about 0.4%. But it's really some of these long-term goals that the company has put forward and continues to deliver on, and investors kind of hanging their hat on at this juncture. Kind of going forward from here, one of the main things that really jumps out, especially after this company just a few weeks ago had talked about where their net revenue had continued to grow, and ultimately the increase that they saw compared to the same period in 2023, that increase was about 32%, just shy of that. And the street is largely continuing to try and bake in what this means, not only for TSMC, but also for the rest of the semiconductor industry.
Yeah, we pay such close attention to this one, Brad, because TSMC, largest contract chip maker, and you think of the clients here. I mean, it's just a who's who of names we talk all the time about. Their clients, it's names like, it's the Apples, it's the AMDs, it's the Nvidias. So if you're an investor here, you're thinking, okay, it's poised to cap its best annual stock performance in 25 years. What are the catalysts ahead? Certainly one could be, of course, and you were just kind of referencing this, Brad's own financial performance. Bloomberg says the company expected to report sales growth of 36% for the December quarter, gross profit margin of 58.3%. That would be the highest since 2022. And maybe also another catalyst, you're looking for Jensen Huang and his keynote CES, depending on what Jensen has to say, possible catalyst as well.
No, that's a great point. And one of the huge factors that you just mentioned in that growth rate as well, it runs even higher than what their compound annual growth rate. And of course, it's a longer period of time that they were putting that out, about between 2021 and 2026, looking for their revenue compound annual growth rate to be between 15 to 20% in US dollar terms. If we continue to see knock out of the park type of figures like 30% growth, then that could get readjusted by some of the investors out there.
All right, we wait and see. Let's turn to another big name here. We're also watching Starbucks today as baristas continue to strike. It's part of a planned 5-day walkout walkout over contract negotiations that caused about 60 stores to close yesterday. Starbucks Workers United says the walkout will affect more than 300 locations across the country today. So, you look at Starbucks, Brad, 2024, if you're an investor in this name, the year can't probably end soon enough, right? You're down in the red. We're down about 10% here for the year. And normally you see kind of a dip like that. Maybe analysts on Wall Street start kicking the tires. They think, well, that's an opportunity. I'm looking here. It looks like the folks who are paid to give you an opinion on what to do with the stock, they're still, even now, they're fairly split on what to do with it. I get 18 buys, 17 holds, and 5 sells. So plenty of disagreement on the street of where it goes from here. Of course, some of that is because we have some uncertainty. There's been big changes in leadership in the C-suite. CEO Brian Niccol is in, told us here at Yahoo Finance he's focused on operational changes, focused on getting Starbucks back to serving fast coffee, but certainly a range of both operational issues, cultural issues. He's got his hands full.
Yeah, there's kind of 4 pillars that really spell out some of the Starbucks perils that we've seen over the course of this year. The leadership transition, that was the question mark. That's kind of been moved through, or at least now they have some clarity on what Brian Niccol could do going forward. He's a leader that has been looked at across the industry as one that is very technologically savvy. We'll see what more he can influence and make sure that Starbucks continues to track not just the digital body language, but also make sure they're converting that into real in-store visits or purchases and increase on the average ticket size. But the other 3 that I would be looking at here is the softness in North America, number one, in the consumer. And then you've also got the China consumer as well here, where if we were to see any type of changing in the investor sentiment around the companies that have the most revenue exposure to China and in their growth plans, Starbucks falls squarely in that bucket as well. And then just lastly here on the labor side, as we've been mentioning, and started off the conversation with, when you think about the representation for Starbucks Workers United, they represent employees, 525 stores nationwide, and 60 of those stores are in 12 major cities. You think about Boston, Seattle, which is, of course, the tentpole and the origination of the founding city for Starbucks, and also New York and Los Angeles here.
I'm also interested too, Brad, like a bigger question is what Starbucks, like what is the experience they ultimately want for Josh and Brad looking at? And I say this as a Starbucks fan, as someone who spends too much money at Starbucks. is it a place where like Brian Niccol wants me to like just get Josh through as quickly as possible, or a place he wants me to get a cappuccino, open up a book, relax for a while? We'll see. Maybe both. I don't know. Coming up, it's the opening bell on Wall Street. That's when we return. Stick around.
You're watching Morning Brief, brought to you by Invesco. There's a live look at the opening bell here, taking a look at the New York Stock Exchange security team. Great group of folks over there ringing the opening bell, keeping folks safe all year around. And at the Nasdaq, you've got the Lyshon Group ringing the opening bell, ticker symbol LSE, kicking off today's abbreviated trading session. We're taking a look at the Dow Jones Industrial Average, kicking off the day flat, but to the upside here, it's up by about 0.07%. The Nasdaq Composite, though, you're seeing some solid gains, though, by about 0.25%, leading the pack on a percentage basis for the U.S. major averages here this morning. And the S&P 500, you're seeing that up by about 0.1%, sitting right in between there. Let's take a look. Since we've got the Nasdaq 100 already pulled up, let's take a look at some of these mega cap tech stocks to begin today's trading activity. And you've got Microsoft flat just barely to the downside here. Apple, it's moving higher by about 0.3%. And then additionally, Nvidia flat, but to the upside by about 0.2% out of the gate here this morning. So some fractional gains here. It seems like Broadcom, one of the more outsized leaders here to begin today's trading activity. Not a lot of volume expected on the day, of course, as is the case typically with most holiday abbreviated trading sessions. And so we could see this kind of be a range bound and flattish type of day. But one of the huge things that we want to check in on, as well as we always do, the 11 S&P 500 sectors. As we begin today's trading activity, we're looking relatively split as you can get for 11 sectors here. But ultimately, you've got some leaders and some laggards. Your laggard right now, the bad news first, real estate, that is moving down by about 0.4% to begin today. However, up by about 0.5%. Consumer discretionary, that's up today to begin today's trading activity, and year to date, let's just take a look at things. It's up by about 29% here. So that's a brief look at what's transpiring here as we begin today's trading activity. We'll ride out with a look at 30 components in the Dow Jones Industrial Average. Josh?
All right, Brad, it's time now for today's strategy session. We're talking about the outlook for the markets in 2025. And joining us now is Tom Hanlon, National Investment Strategist at U.S. Bank Asset Management. Tom, it is good to see you. So we're wrapping up 2024, Tom. It has been a stellar year. The S&P 500 tacking on about 25%. As we look ahead to 2025, Tom, it seems like you think the party continues. We're going to keep moving higher. Most strategists that come on, Tom, it seems like they're figuring about a kind of a high single-digit gain for the SPX, the S&P 500. Is that about roughly what you're looking for next year?
Hey, Josh, great to be on. Great to see you. And hello, Brad, as well. Yeah, I mean, Josh, we're penciling in about 6,500 or so on S&P 500. That's about 8% or so up from here. We'll revisit that when we get fourth quarter earnings in mid to late January and see where companies are. But the three trends we see ending this year, we see persisting in the next year at least. You've got consumer spending. You mentioned that earlier. That's the bulk of the economy. That remains resilient. Happiness about inflation, but they're still spending with their wallets. And so that's the bulk of the economy. So we see a strong economy heading into 2025. Second trend you mentioned, which is business spending on AI remains resilient. So we're hearing it from the companies that are buying. We're hearing it from the companies that are selling. So that's another strong backdrop for the tech sector as well. And then third, we see, inflation at least is stable here. It's a little higher than the Fed's target, but it's stable. And the
Tom,
direction of the Fed funds rate is at least lower heading into 2025.
Tom, I think we're having some technical issues there, but we thank you for your time, sir. Appreciate the insight. All right, it is time now for let's do a quick market check first here, Bradley. I'm seeing some actual green across the screen here. Well, actually, yeah, look at that. The Dow is tacking Dow's down about 21 points. We're relatively flat. The S&P 500, meanwhile, your broad gauge, that's up about 0.2%. The Nasdaq, your tech-heavy gauge, that is up about 0.4%. Of course, we know big tech has been the place to be for investors. It's time now for our chart of the day. Let's send it over to Brad across the studio. Brad.
All right, well, Josh, our chart of the day is a little bit more special here today because we are tracking Santa. And of course, as we are seeing the year over year, and we could track the year over year in the gifts, we could talk about the corporations that are also helping track Santa. Two of of the Mag 7s actually in Amazon and also in a big name like Microsoft that are really weighing in to make sure that this can continue forward in the transition. 2 of the Magnificent 7 companies joined the combined corporate forces to help NORAD track Santa this year. This uses the same systems, of course, we use every day. Satellite systems, high-powered radar, jet fighters as well. And so here you're taking a live look as it seems like he's moving towards or over the Great Wall of China and is over the Asia-Pacific area right now. For more than 65 years, folks will remember that NORAD and the Continental Air Defense Command, that was the predecessor for NORAD, have tracked Santa's flight around the world. And so this brings us our special chart of the day. This is a modern tradition and began back in 1955. And guess what the story behind that is? Yeah, a young kid accidentally called this phone number that was unlisted, and it was the Con Ed Operations Center, and they saw a newspaper ad basically telling kids to call Santa. So that's where we began, of course, this transition and this tradition, and now you see Santa Claus transitioning throughout the world and dropping off some presents. We'll continue to track the flight as well as everybody who can go online and track NORAD's Santa Tracker as well, Josh.
All right, thank you, Brad. Coming up, we're taking the future of nuclear energy and some of the top names in this space.
For more than 6 decades, the discount megastore Walmart has redefined retail. In 2023 alone, the company brought in more than $648 billion in revenue. Beyond the Ticker takes a deep dive into the company's biggest moments. Walmart was founded in 1962 by Sam Walton. Its first location was in Rogers, Arkansas. 5 years later, the Walton family owned 24 stores and had racked up $12.7 million in sales. On October 1st, 1970, Walmart went public via an IPO on the New York Stock Exchange. Shares opened at $16.50 per share. The company opened its first Sam's Club in 1983 in Oklahoma in a bid to compete with Costco's wholesale member-only model. In early 1988, founder Sam Walton stepped down as CEO, and David Glass was named his successor. That same year, the first Walmart Supercenter opened in Washington, Missouri, creating what it's currently known for, that mix of general merchandise and grocery. In 1996, Walmart opened its first location in China and surpassed $1 billion in sales for the year. Walmart.com launched in 2000, allowing U.S. customers to shop online as Amazon.com began to take off. To compete with Amazon, among other online retailers, Walmart introduced free 2-day shipping in 2017. During the pandemic, the retailer boomed as consumers sought out the COVID-19 vaccine and meant cheaper groceries as inflation picked up. In 2024, it acquired the connected TV platform Vizio in a $2.3 billion deal, and it only keeps growing from here, with more than 10,500 stores in 19 different countries.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO, you want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes, is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
For many years, Yahoo Finance has crowned one company as Company of the Year, but this year we decided to go bigger with a suite of awards.
Company of the Year, that's today, and it's Walmart.
We invested in lower prices, we invested in e-commerce, we invested in technology, and we just kind of haven't looked back since then.
We are revealing our Surprise of the Year award. It is General Motors.
We have the strongest internal combustion engine portfolio we've had in a long time, and this was the year of EVs.
Nvidia, the chipmaker, continued its dominance from last year, making Blackwell Yahoo Finance's choice for Product of the Year.
There has been such anticipation and such demand from the hyperscalers to get it to power their data centers.
The Yahoo Finance Comeback of the Year award, Robinhood.
I see multiple paths to Robinhood growing by 10x.
That's a wrap on Yahoo Finance's 2024 awards. Thank you for watching.
Nuclear stocks rallied in 2024. Let's take a look now at a few specific names. Constellation Energy, that's up 95% year to date. NuScale up just under a cool 500% year to date. And of course, we got to talk about Oklo, backed by Sam Altman, up more than 100% year to date. But Bloomberg reports several hedge fund managers are actually coming back on their nuclear investments. For more on what's ahead for nuclear in 2025, let's welcome in now Mark Nelson, Radiant Energy Group Managing Director. Mark, it's always good to see you and have you on the show. So listen, there was obviously, Mark, and we've talked about this, just a ton of excitement around all things nuclear in 2024. Big, important theme for investors. How do you see, Mark, this theme and trend? How do you see it evolving now over the next 12 months as we head into 2025?
Well, we got to look backwards a little bit to look forwards. 2023 was the year we started hearing some of the tech players behind the scenes thinking about nuclear more. 2024, huge year. It's like the whole world discovered nuclear. The way I'd put it is everything kind of became about AI, and AI became about energy, and suddenly people realized that the tech players did not have a realistic energy growth strategy. They said they were using 100% renewables when they were just going off the grid. Well, they ran out of grid. So what we're looking at now is a 2024 where the biggest banks, a bunch of the world's countries, all made commitments to saying, we love nuclear. That's not the same as building nuclear, and 2025 is going to be the year of show me.
With that in mind, I mean, we've heard a remarkable, and this kind of gets back to what you were saying, we've heard a remarkable amount of companies in the cloud space, even talking about nuclear reactors, that they're interested in fast tracking some of their own build out around. What is the timeline that we should be kind of gauging or grading these companies up against when you hear companies like Salesforce or like Oracle talking on their earnings calls about nuclear reactors and how much they're earmarking to invest in that?
I think what's become clear is that the top executives of these companies were sort of blindsided by the energy problem, and they're scrambling to learn as much about energy as quickly as possible. Nuclear is a special form of energy. They're learning about nuclear as they go. One of the difficult things I have to deal with is hearing announcements from companies and attempting to translate that into nuclear reality. What does it mean when it says we have a license to build? So trying to understand that is one of the most difficult parts of my job. What I can tell you, though, is the noise is all in the right direction for those of us who want to build nuclear plants. We just have to be able to respond. I don't think that the tiny reactors are going to be the bulk of the long-term future, and I think I'm backed up by this, by groups like the International Atomic Energy Agency, which sees them as being the small reactors, maybe about 25% of the nuclear market by 2050. What I see, though, is these small reactors helping companies like Oracle explore nuclear at all. Most of America's nuclear plants can power a few million people, but could be doubled in size if we started building more reactors. So what I'm looking for is commitments to build, either the small ones or the large ones, coming through late 2025 and early 2026. That would, to me, indicate that the nuclear fuels stocks, the nuclear supplier stocks would continue to see support like we've seen from this 2024 year of nuclear discovery.
Mark, I'm curious, Trump is moving back into the White House. What does that possibly mean for the industry? What are ripple effects? For example, he wants Chris Wright as his energy secretary, notably does serve on the board of Oklo, Mark.
I've heard nothing but good things about Chris Wright from the energy space. my family is in oil and gas. I grew up in the traditional energy world before switching to nuclear. It's very interesting to see a coming sort of joining between the biggest energy consumers and possibly the biggest traditional energy companies over exploring nuclear. When I see Chris Wright's coming in, I see somebody who loves what he's heard from the nuclear story, and his job at the Department of Energy will be to see how he can continue the momentum from, say, the DOE loans office attempting to bring in nuclear players to issue loans to build reactors. I think the big question for me is whether this is going to be a nuclear inclusive story. Is this going to be one of just small experimental reactors, which, don't get me wrong, are very exciting. I'm interested in advising some myself, but also the large traditional reactors whose incredible performance to date in operation, not construction, has led to the possibility of a nuclear boom that we've been seeing.
Mark, what kind of real estate is necessary to bring online more nuclear, and what type of deregulation would that need to be coupled with?
Well, honestly, the real estate play for me has been more about building load, building data centers on farmland around nuclear plants. We've heard of at least one case where a nuclear reactor was possibly going to be restarted, except that the current plans have been interrupted by a rare bumblebee that might be present on that land. So I think that there's going to be some common sense approaches to nation-critical energy supply projects, like turning nuclear plants back on or expanding them if there's a accommodation for the protected species, that I definitely expect to move faster in the new administration. I don't personally see an enormous acceleration from deregulating the reactor technology itself. I think that there's a long history of aggressively exploring nuclear reactors back in the 1950s and 60s, where we discovered which types worked well, which types didn't well. I think we're going to update some of that with some new techniques and some new talent. But the main thing for me is seeing people willing to take the risk of tens of billions of dollars coming together in a consortium approach to put together the users, the sellers, and the reactor vendors all in one package deal to avoid the errors that have plagued nuclear construction in the past.
Yeah, Mark, really fascinating. And I feel for that bumblebee too. Whatever I can look up after this, you've now piqued my interest in seeing what that impact is as well. Mark, thanks so much for taking the time.
Thanks for having me.
Certainly. Coming up, we're running through 3 stocks in 30 seconds each. That's next when Morning Brief returns.
For many years, Yahoo Finance has crowned one company as Company of the Year, but this year we decided to go bigger with a suite of awards.
Company of the Year, that's today, and it's Walmart.
We invested in lower prices, we invested in e-commerce, we invested in technology, and we just kind of haven't looked back since then.
We are revealing our Surprise of the Year award. It is General Motors.
We have the strongest internal combustion engine portfolio we've had in a long time, and this was the year of EVs.
Nvidia, the chip maker, continued its dominance from last year, making Blackwell Yahoo Finance's choice for Product of the Year.
There has been such anticipation and such demand from the hyperscalers to get it to power their data centers.
The Yahoo Finance Comeback of the Year award, Robinhood.
I see multiple paths to Robinhood growing by 10x.
That's a wrap on Yahoo Finance's 2024 awards. Thank you for watching.
You're watching Morning Brief, brought to you by Invesco. We're taking a closer look at some of the top tickers in the S&P 500 as we enter the final trading days of December, and we're doing it in 30 seconds each. First up, at the top of the S&P 500 leaderboard, we've got Vistra, the electric utility company, getting ahead of the pack through its strategic positioning and along with acquisitions, including Energy Harbor, a move that sets Vistra up to get deeper into the nuclear space to meet the power demands of the AI boom. Vistra also delivering solid financial performance this year with positive guidance, all contributing to the stock outpacing Nvidia as the biggest winner in the S&P 500.
And as for market darling Nvidia, it is holding on to the second spot among the best performers of the S&P 500. The chip maker dominating 2024, of course, as it repeatedly swapped places with Apple as the largest publicly traded company in the world by market cap, topping the $3 trillion mark. But with its success also comes challenges as the company now navigates its exposure to China. But the chip maker is still a top pick on Wall Street for the coming year.
And lastly, taking a look at GE Vernova, another energy name with sizable gains this year. That stock is up roughly 143% so far in 2024 after the clean energy business spun off from General Electric. That was back in April. And the company since has announced that its first dividend is coming forward as an independent company. And looking ahead, the future appears bright as the company also raised its multi-year financial outlook. Shares this morning pulling back a little bit, but still very solid performer over the course of 2024 here. That does it for the Morning Brief. Join me and Josh Lipton in the next hour for more analysis on catalysts. It's coming up.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO. You want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes, is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
Welcome to Catalyst. I'm Brad Smith alongside Josh Lipton. We are 30 minutes into the U.S. trading day. Let's get to 3 catalysts that we are watching heading into 2025.
And first up, investors contemplating an uncertain macroeconomic backdrop marked by the Federal Reserve's ongoing concerns about inflation and the potential impact of policy proposals from President-elect Trump. The focus for investors will be hedging against any volatility. We'll discuss.
Plus, the 2024 housing market has been plagued by high mortgage rates, prices, and low inventory. When can we expect a rebound? We'll talk to an expert.
And the Santa Claus rally kicks off today. Wall Street is watching to see if Santa delivers a positive year-end. We're going to talk about what this year's rally could mean for next year's equity markets. All right, we want to dive into 2 specific catalysts in 2025. I'm kicking it off with a key event next month, the inauguration of President-elect Trump. And this one, Brad's been interesting. Listen, there's a ton of uncertainty into next year. You can talk about uncertainty about the economy. Yes, it's resilient now, but what about the quarters ahead? Some of the recent data, you got consumer confidence this week. That wasn't so great. You got uncertainty about the Fed. Yes, they gave you a cut, but they signaled fewer cuts next year. And then also, indeed, Trump coming back in, and all the uncertainty around fiscal policy, whether it's taxes, deregulation, immigration, tariffs. I think a lot of folks might have thought because you had that red sweep in Washington, you were just going to push a lot of this right through. But after that near government shutdown we had, probably some folks thinking, you know what, maybe pushing that through is going to be so easy. Maybe a lot of that legislative agenda could even be in question.
Yeah, a lot of question marks around what that means as well for technology too. And since we're talking about technology, one of the things that I'm keeping my eye on, of course, as a catalyst is big tech. We have CES in Las Vegas starting January 7th. This is essentially the first major trade show that we see cyclically every year. And Nvidia CEO Jensen Huang is the keynote speaker. Why does that matter? Oh yeah, one of the best performers in the market for the past 2 years. It's made its way into the kitchen table conversations for many households here as an investment thesis around AI continues to prevail. And a larger question for some of the other major announcements within technology around computation and what that could mean for consumer tech, that's going to be in focus here. And I was actually taking a look at some of the big trends that Deloitte is anticipating going into 2025. They talk about computation in PCs and in the Internet of Things and AI getting even more physical. Consumers feeling like it's more tangible and that they can touch it, they feel it, and they also see the benefits perhaps of it as well in tandem with some of the larger organizations that might be looking to deploy everything from agents to just beefing up their data centers as well. And so as I think about some of the individual devices that we're set to see this roll into, whether it be operating systems as Apple has been talking about, that's one ticker to keep your eye on going forward into 2025 with some of the new OS updates there for artificial intelligence and the focus there. But the Internet of Things more broadly, as Deloitte says, it's going to be more robust in areas like medical devices and robotics. And it isn't only the processor's power that's improving, they're becoming more energy efficient as well. So there are a couple trades that actually really surround this as spokes within this AI hub that are going to be important to watch as we go into CES, which is the catalyst that can really kick off that conversation for the technology landscape.
I think Nvidia is so interesting because I know there's been some recent weakness, I get it, but if no one who's been long Nvidia this year is complaining at Christmas dinner, right? And what's interesting is how many analysts come on, and broadly, the bullishness with this name still, right? And maybe you could obviously see that as a contrarian indicator if you wanted to, but broadly, we just have analysts come on, Brad, who know the company backwards and forwards and just believe that the hyperscalers, the big cloud giants, their bet is they just keep spending to build out AI. And that man right there, Jensen Huang, is going to benefit. And then you ask them, who is the competition actually?
Yeah.
And they'll say actually maybe his own customers, those hyperscalers, those cloud giants.
Or his own cousin.
Absolutely. Lisa Su over at AMD.
Yeah.
But they don't say that's a near-term thing, maybe an intermediate thing, because frankly, he's just got the tech, he's got the install base, he's got the developer ecosystem. It's hard to see how he gets touched.
Yeah, I'm bullish leather jackets if Jensen Huang continues
to motorcycle leather jackets in particular.
Exactly, right? You
Pull
see
that
that
off.
I'm trying my best. Over the course of 2024, the Federal Reserve managed to thread the needle of lowering prices without triggering a recession, but Jerome Powell is ending the year still plagued by one issue, and that's inflation. Yahoo Finance's Jennifer Schoenberger has more on this. Hey, Jennifer.
Hey, good morning, Brad. That's right. The Federal Reserve achieved the unthinkable for 2024. The central bank managed to keep the economy growing and at a strong clip while keeping interest rates elevated for the bulk of the year to bring inflation down. But the Fed is still ending the year the way it started, worried about stubborn inflation. This year, unemployment rose but never got out of control. The economy remained surprisingly strong, and policymakers felt good enough about their progress on inflation to start cutting rates for the first time in more than 4 years, eventually cutting 3 times by the end of this year. Fed Chair Jay Powell, at his last press conference of the year, sounded pleased with the way 2024 turned out.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. If you look around the world, there's just a lot of slow growth and continuous struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
But while a key gauge of inflation tracked by the Fed is considerably lower than it was at the peak of 2022 and down from a year ago, it's still above the Fed's 2% goal, and it's been moving sideways this fall. Looking ahead, officials expect inflation to remain somewhat elevated. At the same time, new policies from the incoming administration could create uncertainty for Fed officials. Powell made it clear that he needs to see more progress on inflation before the Fed cuts rates again, and that the Fed would be moving cautiously. On that note, the Fed is now projecting only 2 rate cuts next year, scaled back from 4 previously. Back to you.
All right, thank you, Jennifer. Appreciate it. Stocks seeing the impact of the Santa Claus rally so far today, but last week saw some of the most volatile trading of 2024, but more could be on the horizon thanks to a new administration in Washington and ongoing geopolitical concerns. Here to explain how you should be playing markets in 2025, George Schulze, Schulze Asset Manager, founder, managing member. George, it is good to see you. So we're wrapping up a strong 2024. George, I'm sure clients are coming to you and they're asking you, George, how should I be positioned in 2025? What are you telling them?
Well, great to be here, Josh. Thank you. Merry Christmas. So last week was extremely volatile, with this news that the Fed is signaling it's going to likely cut interest rates just 2 times next year after cutting its benchmark rate by 0.25%. That led to all sorts of uncertainty. The volatility index soared last week, and then it recovered and then soared again. The VIX last week was, I guess it suffered a second biggest spike in history last Wednesday. So monetary policy is clearly changing. Before last week, which was the final Fed meeting of 2024, Wall Street was expecting multiple additional lowering of rates going forward. Now he's indicating that the Fed will likely continue monthly rounds of quantitative tightening, reducing the size of the balance sheet by $25 billion a month of treasuries and another $35 billion a month of mortgage-backed securities, which not that many people are focused on. Most people are just focused on interest rate policy, but this continuing QT is also very important. So as your last speaker just said, the economy is still growing just under 3% for the year. And while risks of inflation have crept up, CPI is getting closer to the target rate of 2%. So right now it's at about 2.7%. However, unemployment is at near full unemployment, unemployment, at about 4.2%. So the Fed's getting closer to their neutral policy goal, but there's a lot of debate about exactly what neutral policy is. And on the other hand, with respect to U.S. fiscal policy, there's a lot of uncertainty, as you gentlemen just pointed out a moment ago. We have continuing massive fiscal spending deficits. And there's all sorts of uncertainty with respect to government funding, as we saw last week with the near government shutdown again, and there'll likely be more churning of policy decisions going future with the new administration coming on board. Of course, also a lot of uncertainty about future tariff policy and how that may impact the economy, as well as inflation going forward. So having said all that, it's been a great year in the stock markets. And right now, we are advising investors at Schulze Asset Management, our clients, to exercise a little bit more caution, maintain some dry powder, and hedge against risk of market volatility like we saw last week, and instead focus a little bit more on short selling opportunities. On the long side, we are advising clients to maintain liquidity, to protect capital during market shocks, also cut losers very quickly, and focus on certain value-oriented investments that have event-driven characteristics.
You know, to what extent do you believe that the unwinding of the Fed's balance sheet could contribute to more market shocks?
To a high extent, actually. I think it's a big number. If you add back the mortgage-backed securities as well as the treasuries that they're selling, and that's taking a lot of liquidity out of the market. However, it's also been telegraphed that they'll probably stop quantitative tightening sometime in maybe the late first quarter, early second quarter of next year. Of course, we'll see how that all evolves with the new Trump administration and how that impacts the overall economy and also just confidence in the markets.
So George, our conversation very focused here on the U.S. and for good reason. I'm just curious, when you talk to clients overseas, George, internationally, are you eyeing any opportunities there?
We tend to focus more on domestic companies, but there are some interesting things that are changing overseas. In China, we are all waiting to see what kind of stimulus the government will release when and if tariff policy really officially takes place. That'll be important to watch whether or not you invest there. Also in Japan, there have been all sorts of structural changes in that economy over the last few years, which is creating some interesting value investment opportunities. In Europe, we're a little more cautious. I mean, there's a lot of uncertainty there. The economy is suffering some of the similar trends that we have here, but they're obviously not, the global powerhouse that the United States is.
George, as you're thinking about one particular name, and we're taking a look at this in your notes, Vistra Energy, of course, one of the largest outperformers over the course of 2024. What type of momentum do you need to see in not just how they perform this year, but the permeation of that into next year to believe that it could still be one of the top players?
This is a great company. Thank you for the question. Yeah, it appears to have been oversold recently. Ticker is VST. And we expect Vistra Energy to rebound going forward as we get more fundamental news. This is a utility holding company. It operates in 20 different states across the nation, selling electricity and also generating electricity in numerous markets. Its predecessor, a company called TXU, restructured in bankruptcy in 2016 after eliminating $40 billion in debt. And separately, in 2012, its Dynegy subsidiary also restructured in bankruptcy after eliminating $4.4 billion in debt. So the company combined has a really clean balance sheet. Earlier this year, it acquired Energy Harbor, which added 4,000 megawatts of nuclear power generation capacity and made Vistra one of the largest zero-carbon generating platforms in the United States. And just regarding the electricity market in general, electricity generation had become a pretty mature industry, but it's growing now because of new electricity demand from data centers and electric vehicles, and also from hyperscalers like Amazon and Microsoft, who are signing new electric supply agreements. So we think there's a lot of upside potential for Vistra. The company is also conservatively run. Its business, its revenues, and its costs are hedged for years going forward, and they just increased their guidance. Lastly, they've been aggressively buying back stock. They had a $5.1 billion capital return program, which has reduced their share count by over 30%. And so going forward, we think there's a lot more opportunity for Vistra.
All right, we're going to continue to track it going into 2025. George, thanks so much for taking the time.
Thank you. Merry Christmas.
Merry Christmas. While sales of new U.S. single-family homes rebounded in November, rising mortgage rates continue to be a pain point in the housing sector as buyers and sellers adjust to the reality of today's higher rates. We're looking at the setup for the U.S. housing market in 2025. Walton Global Executive Vice President of Capital Markets, Katie Hubbard, joins us now to discuss here. Katie, good to see you, and thanks so much for taking the time here this morning. So what type of rebound or what type of momentum are you anticipating in the housing market for 2025?
Yeah, Brad, thanks so much for having me. I mean, our clients are public home builders, and National Association of Home Builders has reported that home builder sentiment is at an all-time high since April 2022. So we're feeling bullish on the new home housing market. Home sales are up 5.9% month over month, 8.7% year over year, and all of our clients are anticipating building and selling more homes in 2025 than they did in 2024.
And Katie, where are there certain states, regions where you're going to see that building more than others?
Yeah, absolutely. It's definitely regional. So the South continues to have a lot of new home sales and is doing well. However, there are expensive markets like California it's more difficult to build there. Home builders are having to offer less incentives, but there's less inventory in places on the West like California. You're seeing some increased communities in mountain states like Montana and Idaho as well.
You know, it's interesting because as you kind of look across the new home side of the equation versus the existing homes, some data out from Redfin this morning and a comment from their senior economist noting that elevated mortgage rates are likely going to cause many homeowners to hang on to their homes, and the low rates they have locked in, meaning there will be enough buyers competing over a relatively low number of homes to keep prices ticking up consistently. As you think about that playing out in the existing homes market, what does that spell out for the propensity for buyers to actually come into the market at higher prices on the new home side?
Yeah, absolutely. I mean, existing home inventory still remains low at about 3.8 months, while new home inventory actually ticked up 2% month over month. So we're at about 490,000 homes on the new home side. And that is just under 3 homes per community of unsold available homes. But that's at really the high end of where our clients like to, they like to cap it at no more than 3 unsold homes. But we're still seeing price declines in new home sales versus existing homes where the prices have continued to increase because of that low inventory. So our clients are still, offering incentives like mortgage rate buy downs. Because of the elevated mortgages, we don't think mortgages are going to get to 6%, not even until 2026, where that magic mortgage rate number is really 5.5%. So it's going to cause, there's still the elevated mortgages causing affordability issues on both sides.
So, Katie, your clients are, and I understand they're committed to these mortgage rate buy downs. What does that mean for their margins?
Yeah, so their margins are still relatively high right now. I mean, they're operating extremely well, especially we provide land to public home builders for land banking, which helps with their margins. So the public home builders, the large ones are continuing to get bigger and improve their margins, where maybe small ones are struggling who don't have the same ability.
All these things considered, as you're thinking about the type of home buyer that we're anticipating will drive much of the demand in 2025, what generational scale does that come in at?
Yeah, so the first-time home buyers are making up about 30% of the market right now. We're in a robust market. First-time home buyers are 40%. But what's interesting is that the age of the first-time home buyer has increased. So they're now 38 years old buying their first home. So you're seeing, older people buying their first-time home. They're willing to accept smaller homes, higher density, as long as there's that community space. And then groups that don't have a mortgage, so maybe they're buying their second home or they're going into 55-plus communities home. The public home builders are really building the product to meet the demand of those groups, not only the older first-time home buyer, but then the move-up or retirees.
I'm curious, Katie, in your opinion, any way Washington can step in and help this sector, the housing sector specifically? On the campaign trail, of course, this was a hot button topic. Trump and Harris both talking about it, both talking about different ways to, for example, boost supply. Your thoughts on that?
Yeah, I mean, our clients are really on the wait and see as far as the new administration coming in, because of one, labor and immigration costs could go up, causing home prices to increase. Also, tariffs could go up, causing prices to increase. So those are really where we're at the wait and see. But many people think when they hear the Fed lowering rates, that's going to automatically lower the 30-year fixed mortgage. They don't realize it's more tied to the 10-year Treasury, where the spread over the 10-year Treasury to the 30-year fixed is much higher than the average. It's typically 190 basis points above, and we're sitting at about 230 to 250 basis points above the 10-year Treasury. And so what Washington can do is, just be cautiously, moving towards, the tariffs and, the immigration policies that won't really dramatically affect the new home builders.
Katie, great to see you and have you on the show today. Happy holidays.
Thanks, Josh and Brad. Thanks for having me.
And coming up, we're looking at today's Yahoo Finance trending tickers. We're going to give you the news behind the moves next on Catalyst. 2025 could be a big year for changes in the healthcare sector, and Yahoo Finance's Anjali Kamlani joins us now with a look at the 3 catalysts for healthcare in 2025. Anj.
Yeah, I mean, I really had to narrow it down because there's more than 3, but we'll leave it at 3 just to make it simple. I'd say the first one, obviously the biggest one everyone wants to hear about, is GLP-1s. We know that the weight loss market has skyrocketed, and it also has a little bit of growing pains now. So taking a look first at the tickers that matter, we know Lilly and Novo Nordisk are the 2 big ones to keep an eye on, but there are some smaller ones coming up behind, including Viking Therapeutics, but also Amgen has one that's really interesting that could change the market because it has a once monthly injectable that it is looking at bringing into the space. Now, it's important to note that what analysts are thinking about it is that it's still kind of uncertain. So we heard from Jared Holes, Mizuho's healthcare expert, saying this entire obesity category remains one of the most intriguing in all of healthcare, given the potential market size and its more consumer focus. There's no doubt that the future data sets will continue to reshape thinking on how the treatment regimens involved and which companies and stocks are best positioned. So where does this come from? We know that, of course, with Lilly and Novo fighting for lead space, Lilly is sort of chugging a little bit ahead. We got a little bit of disappointing news from Novo Nordisk for its latest candidate. Meanwhile, all of these others in the pipeline that could change, maybe with a pill form or how frequently they're used, but we know that the efficacy level could be peaking. That's something to keep an eye on. Meanwhile, PBMs, that's another one that we know, of course, has taken a lot of oxygen in the end of the year, especially post-election with the Trump administration looking to come in. Some talk, big talk about controlling costs in the system and calling PBMs the middlemen. We know that Trump had some fighting words himself talking about the fact that he could be controlling that. We also know there you go, knocking out the middlemen and taking drug costs down to a level no one has seen. Now, whether or not Congress will be able to move on this, whether or not the administration will be able to move is the question, because we just saw Congress step back from any legislation that could take control of that in the upcoming year. So now it just sort of resets the clock, and we'll have to see whether or not that will impact the major stocks. Of course, United Health, CVS, and Cigna bear the brunt of this if it goes through. Another big area, and one that kind of comes around every year, this one is almost a cyclical catalyst, and that is pharma M&A. We know that every year it's going to be the year for pharma, and it seems like this year is no different. And so we've seen how mergers and acquisitions have sort of slowed down in the last couple of years. We also know that mega mergers have been under pressure under the FTC leadership of Lina Khan, and that is where folks are waiting to see if there will be change if Trump appoints someone else, if Lina Khan resigns, et cetera. So Michael Yee over at Jefferies told us Lina Khan is viewed negatively for the sector, and there's perception that should Trump nominate someone who's more lenient, that could drive more M&A. But right now, that's an area under some scrutiny, and we'll see whether or not the start of the year, of course, the JP Morgan conference at the start of the year is usually the telltale sign, how those deals work out and whether or not there's the volume of deals that analysts are looking for. So we'll see what happens there.
Absolutely. Some major catalysts to track within the healthcare landscape. Anjali, thanks so much. Now time for one of today's trending tickers here. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. MicroStrategy, ticker symbol MSTR, fired up, purchasing an additional $561 million worth of Bitcoin last week, marking its 7th straight week of Bitcoin purchases. Since October, the company has sold more than $14 billion worth of stock and another $3 billion worth of convertible debt to fund these Bitcoin purchases. And there you're taking a look at the shares moving higher here on the day by about 5.75%. And if you're surprised at all that it's moving higher by about 5%, well, just look at least partially to the move that we're watching on Bitcoin today. That's up just shy of about 3% right now, but this is essentially a Bitcoin holding or a Bitcoin trust at this juncture, even as they regard themselves.
Yeah, and Bitcoin, of course, hit that all-time high of around 108,000, Brad. Pulled back some. That's, reflecting expectations the Fed's going to cut next year fewer times than maybe had been expected. We spoke to MicroStrategy's Michael Saylor on Yahoo Finance recently, the Bitcoin guru himself. Brad, he said, what he told us, Brad? You just got to keep this simple, Bitcoin. Don't overthink it. You know what you do? You just keep buying.
Yeah.
That's the whole thing. This is what he said. I'm going to be buying more Bitcoin, Saylor telling Yahoo Finance. I'm going to be buying Bitcoin at the top forever. Keep it simple. That stock, by the way, up more than 400% this year. And even with that rocket ship, the street loves it.
Yeah.
8 buys, 0 holds, 0 sells. Lots of love for Mr. Saylor.
There is. This one company as well, and wrap your mind around this, holds more Bitcoin than the US government. And as you think about where the strategic reserve has been talked about more by incoming President-elect Trump and what the buildup of that could look like and the purchasing and whatever the accelerated purchasing fashion and how the US government side decides to enter the market even more so to acquire more Bitcoin, to hold it in a strategic reserve. MicroStrategy is one of the names that either could be a holder or a potential seller to the U.S. government and cash in on some of the gains that we've seen thus far as well. That would be a major boon, but at the same time, it sounds like Michael would still be and Saylor would still be buying into even more, even if there was some selling that took place there as well. Remains the largest corporate holder of Bitcoin in the world, holds 252,220 Bitcoins, and that was as of the end of its third quarter report as well.
It's been the right strategy. It'll continue to be the right strategy so long as Bitcoin up and to the right.
Yep.
And it makes sense.
Coming up, investors eyeing the start of a Santa Claus rally here. We're taking a look at what it means for the markets historically. That's next on Catalyst. Santa Claus rally officially kicking off today. That's the last 5 trading days of December and the first 2 of January that historically bring a market rally. Joining us now, we've got Jeffrey Hirsch, Stock Traders Almanac Editor-in-Chief. You say that the odds are still in favor of a Santa Claus rally here. Why is that?
It's not just that the odds are in favor, it's that it's an important time of the year for us to take a check on the market. It's not necessarily a trading rally. It's really an indicator. It's the first indicator of our January indicator trifecta. Santa Claus rally was created in '72 by my illustrious father, Yale Hirsch, who started the Stock Traders Almanac. And it's really important if it doesn't show up. So he coined the phrase, if Santa Claus should fail to call, bears may come to Broad Wall. And then if we get the first 5 days down, the January barometer, which he also created in '72 down, then we're looking at some issues. But the recent selling that we had in December, very typical, early December, profit taking and tax loss selling, kind of sets up, it took some froth off the market, kind of sets up the potential for a Santa Claus rally. So it's not so much that I'm so pumped to trade this rally. It's something I'm really watching to see if the bull market's got some legs, and if we get some breadth, some broadening of the market, and a positive Santa Claus rally. That's the first step to confirming the bull's got room to run.
Let's say, Jeff, that didn't happen. The Santa Claus rally, it didn't show up. We had a failure there. Historically, Jeff, that precedes what in the market?
Times when stocks can be purchased at lower prices later in the year, bear markets, weakness, flat markets. It's generally better when the market's up about 6.5% when you get the market down there, but it's up much more when the Santa Claus rally comes in. But it's just one indicator. Santa Claus can be down like it was in '24, but we had a full year January barometer gain. And that was kind of the clincher for us that things were okay with the market. That's why we stayed bullish in '24. And I don't think we're going to have as much gains in general in 2025, but getting a positive Santa Claus rally will be encouraging that the bull market's got some room.
Yeah, what is that outlook for 2025? I mean, we've heard a range of predictions here, including, but not limited to, of course, a potential correction in the first half of 2025.
I think we've got the potential for some correction in Q1. It's very typical in post-election years, but my overall outlook is for gains about 8 to 12% based upon the post-election year history of 5 years of presidential terms and combinations of, the long-term history going back to 1950 with our aggregate cycle of all years and 5th years. But economics are looking pretty strong. GDP, job market, there's some positive. I think the Fed's on our side as well. Technically, we've seen some correction here, a little overvalued, but I just see this tech boom, this AI macro trend continuing to lift the market at least through 2025. 2026, I'm a little bit concerned about. That's a midterm year when we were notoriously, prone to corrections and bear markets and recessions. But right now, everything seems to be just pretty resilient in the U.S. economy. Be nice to see some broadening. I'd like to see some breadth and some new highs. Sort of confirm that there's more to the market than just the Mag 7 or the Qs.
So you mentioned breadth, Jeffrey. What else might be on your wall of worry there? Would it be valuation, sentiment, positioning?
Inflation, the 10-year. If we get some more month-over-month inflation, that's going to give the Fed some pause, and the market's going to worry about getting, it already got walked back. They reset the expectations, but inflation and the 10-year are really what we're looking at. Sentiment, bullish sentiment can go on for a long time, as we've seen here. The real indication of sentiment is when it's really bad, like we had in October 22 when there was no bulls except me and, a couple other people out there, but very few. So bearish sentiment is a contraindicator, much more so than bullish sentiment. And I think, we can catch up to the valuations with earnings and growth, but really inflation and the 10 years where my concerns lie.
I wonder what you kind of analyze around this number. 25% of consumers expecting the stock prices to decline, up from 21.7% in the most recent consumer confidence reading that we got out to begin this week. How does that really play into the mindset of the retail investor that is trying to figure out how to position their own wealth growth?
I mean, what really drives the market is the institutional investors. So having some bears pick up in consumers and retail investors is encouraging to me. It's what the big money is doing is what really drives the market. So some nervous individual investors is fine. I encourage people to not make any rash decisions at this time of the year. When we get into the end of the best 6 months, another creation of the almanac around April, May, and the end of Nasdaq's best 8 months, that I think will be a time to reposition and take some profits and readjust portfolios. But right now, I don't think there's any reason to get skittish.
All right, we'll leave it on that high note. Jeff, thanks for joining us today. Happy holidays.
Appreciate you guys. Thank you for having me.
And coming up, with one shopping day until Christmas, we're looking at the biggest trends in the retail sector.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO. You want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes, is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
Today's the day. It's the final shopping day before Christmas, and the latest data from JLL suggests the average consumers will spend over $1,400 on their holiday gifts and celebrations. That's 36% higher than consumers estimated in September. Here for more holiday insights and what they tell us about the consumer is Naveen Jaggi, JLL America's president of retail. Naveen, always great to see you. So, based on your data, Naveen, it sounds like the consumer is hanging in there, looking resilient.
Yeah, you got to love the U.S. consumer. They time and time again surprise us about their optimism, whether it's the holiday season or back to school. And I think it really says a lot about the fact that at the end of the day, this consumer economy keeps finding ways to engage with the consumer, and the retailer does a good job of it. And so I give them a lot of credit, and you can't ignore the fact that between the average household net worth of a U.S. today, household going up because of the housing values, I feel really, really good about that, along with the markets, the way they're performing. So I'm bullish on the U.S. consumer this holiday season and in 25.
How are you evaluating the consumer that is increasingly looking for promotions, looking for deep discounts and deals?
Well, let's face it, they are always looking for a great deal. We have become a value-oriented consumer society today. We go to Target, we go to Walmart, we go to Ross Dress for Less, TJX, and those kind of retailers on a regular basis, almost daily, if not weekly. And so I think, to me, that cycle where the consumer shopping today won't change. That won't change at all. I think what we're also seeing is that consumers look for bargains online, and we've seen that uptick in the last couple of years. So as I saw back in Thanksgiving and even before Thanksgiving, heavy promotions by some major brands, including J.Crew, for example, where you would see these 30, 40, 50% off when you walk in the store. That's not going to stop, quite candidly. But at the end of the day, the U.S. consumer continues to find ways to find the best bang for the dollar. And that's where Ross, TJX, Walmart, Target are meeting the consumer.
And Naveen, when they want to go shopping, where are they going shopping? What's the destination?
Well, the first and foremost, they're going to go to the neighborhood shopping center for their daily needs. So if you think about the daily grocery shopping center asset class, we're seeing more and more retailers moving into that sector. So it's not just purely your daily goods and your grocery store. But when they move past that, they go to the mall, they go to the power center, they go where they're going to find the best bargain. And today, if you look at where Target sits and where Home Depot sits and those shopping centers, Walmart sits, you have lots of great retailers that are neighboring them. On average, when you see a Home Depot or a Walmart or a Target shopping center, you'll see 200,000 square feet of ancillary retail within a 1 mile radius of that shopping center. So you're going to find your typical retail power center tenants as well as your F&B tenants within 1 mile. Between 200,000 to 400,000 square feet will be in that area. That's where they're shopping today, Josh.
So what's that hold for your tentpole department stores, and what's your outlook there?
I think the department store has a great story to come in 2025. I think the announcement yesterday about Nordstrom going private is really great news. Sure, Macy's is the big player, as well as Dillard's in the department store sector nationally. But to me, Nordstrom has always been the gold standard and has been for at least 20 years when it comes to their brand being the premium offering in that particular sector. They now have a chance to go private and focus on their store long-term, not short-term. And to me, retail requires a long-term mindset. It does not require a quarter-to-quarter mindset only. And with Nordstrom now having the flexibility to go back to thinking long-term about their brand, takes attention away from Nordstrom Rack, which they pivoted to over the last 5 years, and go back to their major flagship brand. I, for one, am excited about Nordstrom going private. I think that's good news for the mall owner as well as the consumer.
What is the biggest delta that consumers should expect as a result of Nordstrom going private and now the family retaining ownership, but also you've got a new partner in Liverpool as well coming into the fray?
Well, Liverpool's a great operator in Mexico. We've certainly seen their successes down there. And I think because they focus purely on the mall sector, I think that says a lot for what their belief is in the U.S. consumer and on the department store sector. As I said a while ago, I think the department store has legs in the U.S. Does a department store require to have 4 or 5 of their flags in every city in America? Probably not. When Macy's announces closings, they don't announce a major closing in the major cities of New York and Houston and Dallas, Atlanta. They'll announce a closing likely in a tertiary city where they have 3 or 4 stores and they only need 2. So I think, to me, the delta really answers the question of where the consumer wants to be and where the department stores want to be. And that strategy of focusing on the major cities and optimizing their stores in the major cities with their best products, that's likely what we're going to see in 25 and 26.
And Naveen, finally, the Fed last week, obviously you got the cut, but they also signaled fewer cuts ahead in 2025. Walk us through, Naveen, what that means for the American retail sector.
Well, I think that this little hangover we call inflation isn't going away that easily. Housing prices is a big part of the inflation environment today. I think the Fed has to pay attention to that. Though the consumer is robust and they want to spend money, and we saw that in our latest survey after the election, they want to spend 36% more than they had planned on spending, that doesn't take away the fact that the housing costs in America are still exorbitantly high for most Americans. And therefore, that inflation pressure that keeps creeping up a little bit is going to force the Fed to be very careful not to drive rates too low. And let's not forget that the mortgage rates that we expected to drop when the Fed started dropping their rates did not drop. The 30-year mortgage did not drop. And I think that adds a little more inflationary pressure to housing prices, which will result in the Fed moving quite slowly in 26 and 25.
Naveen, thanks so much for taking the time. Happy holidays to you.
Happy holidays to you as well.
All your markets action straight ahead. Stay tuned. You're watching Catalysts. There's a lot of optimism around the media industry heading into 2025, fueled by the hope of increased ad spending and emerging technologies. However, there are challenges facing the sector as well, including a changing regulatory environment and significant shifts in how content is consumed. Joining us now, we've got Naveen Sarma, who is the S&P Global Ratings Media Telecom Managing Director. Great to have you here with us today. So let's talk about the outlook and some of the perhaps tectonic shifts that we could be looking at going into 2025. What is the highest prioritized from your vantage point?
So it's all about streaming again in 2025. We've had a couple of companies get to break even in 2024, but now it's up to the companies to show that they can build on that profitability, build on that scale, and start to drive profitability up towards 10% or even 20%, as some companies indicate they could do in the longer term. And that's important because the streaming cash flow needs to grow faster than linear TV is declining.
Do you think, Naveen, one big thing we should be looking out for as investors next year would be more streaming bundles?
Oh, absolutely. I would call this year or next year as the year of streaming 2.0. It's clear that companies need to be able to reduce churn or need to reduce churn. And that's going to come from not only things like bundling, but also joint ventures. And so I think we're going to see that both domestically as well as internationally.
With all of this in mind, there's been a lot of focus on sports rights over the course of this year too. And a lot of us are going to get a glimpse at how well a player in Netflix that is trying to be a new player within this realm has tested this over the course of the year. Of course, the Jake Paul and Mike Tyson fight, that and the experience, a lot of people will perhaps just think about all of the buffering, the sputtering that took place. Now they have an opportunity with some NFL games coming on Christmas Day. What do they need to show to prove that they can be a true competitor in live sports?
Sure. I don't think I would view the games today, later today, as kind of a test of their technology. But I wouldn't view, if they do have problems, as the end of their sports ambitions or their ability to get the NFL. They've got a multi-year contract with the NFL. And so this will give them an opportunity to test out their technology. If you remember, I remember watching Amazon when they first launched Thursday Night Football, and there were issues there as well. But they've managed to resolve those things. And so I don't see what happens today as the end, but really the beginning of Netflix's foray into more sports and into the NFL.
Naveen, can you actually survive and thrive as a streaming service without live sports at this point?
It's difficult. I think what we've seen in the United States is what consumers sign up for is sports. You can certainly survive. You'll be small, and so you might have to bundle or do a joint venture. But certainly the ones we think that are going to survive longer term are going to have sports as part of their offering, their programming offering.
What is fair pricing starting to look like going into 2025, as we've seen some of those levers be pulled by all of the streaming platforms at the same time that they're chartering some of these different bundling deals as well?
I don't know. It'll be interesting to see. I would look at things like the cost of your pay TV bundle. If you add up all of the streaming services in their ad-free tiers, it's over $120. And so you're basically talking about paying the same amount of money for your pay TV bundle as you would pay for your streaming bundles. And so I think advertising is a really important part of this to keep prices relatively low and to kind of keep them kind of a little below where like a YouTube TV or a Hulu TV is currently priced.
You know, Naveen, Trump going back to the White House, some bet that means a friendlier regulatory backdrop. I'm curious whether you think broadly, media landscape in 2025, do you think we see a pickup in M&A and deal making?
I think we see a pickup in the amount of talking between players. I think a lot of these deals are just complicated to try to put together, not only from the fact that a lot of these companies are very integrated, and so trying to do what Comcast is proposing to do, which is stripping out much of its cable business, is difficult and has a lot of dyssynergies. But I think you also have challenges here about valuation. You have, if media companies want to do deals, they need currency. And a lot of the balance sheets are over-levered, and so they can't use debt. And their equity prices are pretty depressed, and so they don't really want to use equity either. So a lot of those things need to clear. So we may want these deals to happen. I'm a bit skeptical about these deals happening, at least in 25.
Naveen, thanks so much for the time. Is that Darth Vader in a hockey jersey behind you?
It is.
Okay, all right, cool. What team is he repping? Who's he playing for?
That's he's playing for RPI, my alma mater.
Excellent.
Rensselaer.
All right, Naveen, thanks so much for taking the time. Appreciate it.
Thank you. Happy holidays.
Happy holidays. Coming up, everyone, Josh and I will be back at 12 p.m. noon for a special edition of Market Domination and Market Domination Overtime. We'll take you to and through the closing bell on Wall Street. Stay tuned.
Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This is the podcast that will make you a smarter investor. As I always call out here at the beginning, be sure to like us on YouTube, hit us with those 5 stars on Spotify and Apple Music. We appreciate the support and the love. Really, a returning special guest here to the Opening Bid podcast, businessman and former Commerce Secretary Wilbur Ross. Mr. Ross, good to see you again. It's been a while.
Good to see you, Brian.
Thank you. I appreciate it. So we talked to you a couple months before the election. You gave us really some amazing insight on tariffs and how President-elect Trump may be thinking on tariffs. That stuff is proven correct.
Right.
How do you think he will implement these tariffs?
Well, he's consolidated the tariff decision-making and really the whole export-import decision-making more or less under Howard Lutnick, because U.S. Trade Rep had been an independent agency reporting to the president. Now he has said that Howard will be in charge of it plus commerce. And I had a good relationship with Bob Lighthizer, who was our U.S. Trade Rep, but having them two separate things makes the potential for confusion. This way there won't be confusion. And the fellow they elevated to take over as U.S. Trade Rep was Lighthizer's #1 deputy. So he has a total background in everything that's been going on, the trade agreements, the export-import, and everything. So it's a perfect counterpoint to Howard Lutnick.
I can't think of many folks who could, share a good perspective on this, or a better perspective than you. Are tariffs good for businesses? Are they good for the economy? You're a businessman, you're an investor. Is this a good thing?
Well, it would be better if the world didn't need them, but the fact is...
Good point.
The fact is that you do, because under free trade theory, what would happen is each country would make and export whatever it does best, and then they would import the other thing. The problem is every country wants to grow faster, so every country puts in protectionist moves. Our problem is we let ourselves be put way behind by all the other countries after World War II. Right after World War II, we were the unquestioned leader in world economy and had a huge trade surplus, just as we had had for decades before. And even with the new policy of making concessions to Europe and Asia, it took until the 1970s to put us into a deficit position. And then it got worse and worse from there. So it's a self-inflicted wound that's taken many, many years to build up. And now President Trump is going to cure that ruin. So the real end result, we hope, will be lower tariffs for everybody and lower other non-tariff trade barriers.
How serious do you think President Trump is on tariffs, about implementing them, or are they just art of the deal type stuff, negotiating tactic?
Well, it's a little bit of both, but he's deadly serious about them. He went along with my recommendations for the steel and aluminum tariffs at a time when those were very, very controversial. This was back in 2017, 2018. So he knows that they work. And he also knows they work as a negotiating tool, because after putting in the steel and aluminum tariffs, he had me go over to the EU, and I met with the main car company executives, and I said, look, I'm already working on a study about autos, and it's very possibly going to come to the same conclusion that steel and aluminum did, and therefore we'll have to put big tariffs on you fellas if you don't start doing more manufacturing in the U.S. Well, it turned out they opened a lot of new facilities, especially for electric vehicles, which was what we wanted. So it can work both by actual implementation, and it can work by eliminating the necessity to enforce them if you get the kinds of tariffs kind of relief you want.
As someone that served in President Trump's cabinet, you've had a different career than I think some of the folks that he's putting up forth now to surround himself in this administration. What do you make about some, or just think about some of his picks?
Well, the ones I know the best are Howard Lutnick. I have had a business and social relationship with Howard for 30, 35 years. I think he's excellent. Remember, Cantor Fitzgerald was essentially blown up in the 9/11, including his younger brother who was working for him. The only reason Howard wasn't blown up was his youngest son was starting kindergarten and he drove him to the first day of school. But he built it then into a global powerhouse and then also got into the real estate business and a lot of others. So he's made it a very major firm and a very global firm. Scott Bessent is the other one I know quite well.
The markets seem to love him.
Oh, they should. They should love him. Scott was an excellent portfolio manager at George Soros's firm. And while I don't agree with George's politics, he was a wonderful investor. And Scott was part of the leadership of shorting currencies and making fortunes out of doing it. So he understands how currencies and treasuries and government financing really works, because he's been there making money out of it. So I can't imagine anyone with a better experience than he has.
Assuming that Howard Lutnick does become, gets that position, how might his mandate differ from yours?
Well, I think he will go further. Remember, back when we were there, a lot of the Republicans were still stuck in the free trade myth. Now many of those Republicans have retired, and the newer Republicans are much more in sync with President Trump's things. And the Democrats were generally pretty supportive of our policies. And you've seen Gina Raimondo, my successor under Biden, very much continued our same policies, both on imports and on exports. So I think it will be far less controversial than it had been back then.
Have you been able to talk to the president-elect since he won re-election? And how has he been thinking? How's he been thinking?
Well, he's on a big high, as you might imagine. And as you can see, he's already making his imprint both domestically and internationally. And the other great choice that he made is Elon Musk. I'm a big fan of Elon Musk, and I think he was extremely helpful in the presidential election, because young people have a particularly strong, good feeling for Musk. So I think the fact that Musk not only endorsed President Trump, but actually was willing to play a very pivotal role in helping him, helped sway a lot of people who might have been undecided. Then he's hit the ground running. 4 weeks ago, he already had one of his staff people call me and say, "You have touched a lot of the people in a lot of the different departments. Make me 2 lists and make an A by the ones who were good and a B by the ones who were less good." This was 4 weeks ago. So
you're helping him
he's
with
gonna
some of these picks.
Sure.
Wow.
So he's going, and I'm sure he asked other people as well. So they're going to hit the ground running.
What was your key, before we go off to break, what was your key to making it through all 4 years of working in that administration?
Well, remember, I knew President Trump longer and more closely than did most of the cabinet people. So some of his behavior patterns that some people find difficult to work with, I was well accustomed to. And so there were very much fewer surprises for me. I think that was part of it. The other thing is that loyalty is very important to the president, as it should be. But because of the need to appoint 2,000 presidential appointees to cabinet and departmental and other positions, he didn't have with him an embedded infrastructure of people he could call on. So he had to rely a lot on recommendations from friends. And let's say you were a friend of his, and you also had a friend who had been president of a big company but got passed over to be CEO. You might very well call the president and say, gee, this guy is a very good manager. He was president of XYZ. You ought to consider him for a high post. Well, on a resume basis, the fellow sounded fine. Problem was a lot of them were not in sync with Trump's policies, because remember, mainstream Republicans mostly opposed him last time around, and of course all the Democrats did. So he didn't start out with a knowledge base of people. That meant there was some mistakes made in the early hiring. And like any good executive, if he makes a mistake, he corrects it.
Stay with us, Mr. Secretary. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Having another fascinating conversation with businessman and former Commerce Secretary Wilbur Ross. His second time on Opening Bid. Really enjoy having him here. You mentioned Elon Musk. You sounded optimistic on what Elon Musk can do. As someone that worked in government, how much fat is there in government?
Well, it's not so much fat. There is fat. There are overstaffed departments. Most departments, I understand, have fewer than a third of their employees actually coming physically to the office. So that suggests that some of those 2/3 maybe aren't quite that essential. But where the real cutting can come is getting rid of programs that don't do what they should do, getting rid of programs that do not have good cost controls. That's where the real big money comes. And Musk and Ramaswamy, with their helpers, have very clearly identified a lot of these. I would call them abusive situations. Because what happens when Congress enacts a program, it immediately develops a constituency. And that constituency lobbies not only for continuity of it, but for expansion of it, because they benefit from it. Well, it's hard to reverse that, but with enough willpower and with Republicans controlling both houses, and both Trump and Musk being people who are very tough people, very determined people, I think they'll get it done.
Well, how fast, that was going to raise the other question from me. How fast do you think Elon and Vivek could move? What might people see from them in the first 100 days of the Trump presidency?
Well, I don't know which programs he'll hit first. I don't know that he's necessarily made that decision, but I think you're going to see pressure on all fronts. I'm also very friendly with Dr. Oz, who will be the head of CMBS, which is a gigantic source of spending and probably a very good candidate for cost reduction.
I've never, I hope I have this right, you never served in government before this role, correct?
No, he did not.
No, you didn't. You did.
No, well, I had been around the periphery. President Clinton had appointed me to the U.S.-Russia Investment Fund board, and I had been a privatization advisor to Rudy Giuliani when he was mayor. So I've been in and about, but never really in government, and especially not at a cabinet level.
What's your advice to some of these folks like a Dr. Oz, some of these folks that have never had these positions like this? Now they're tasked with large government roles, really shaping policy. How do they get acclimated?
Well, Dr. Oz has a very good background, both as a practicing heart surgeon, where he was a very famous person, and he also has been involved with other aspects of pharmacology and medicine. And he, of course, was involved with Oprah Winfrey and the big shows. He's written 5 best-selling books on health issues. So while he hasn't been in government, he certainly is an expert in a lot of the substance of health.
Another topic top of mind for our audience is what the president may or may not do with Fed Chief Jerome Powell. As someone who has talked to the president-elect, what is he thinking? Where is his heart is at? Do you think he will let Powell serve out his term?
Well, Powell's term will expire a couple years into Trump's presidency. So it's only a question of when he leaves. He's made it pretty clear he does not intend to reappoint Powell. So everybody knows that. But Federal Reserve is at present set up as an independent agency. I think there should be better communication between the Fed and the executive branch than there has been. Powell has been very standoffish, and to me, there's no need for that. You can be independent, but still have a collegial relationship with the president and with others in government. So I think Powell went a little too far. Hopefully, that will change.
Do you think the White House should have a say in Fed policy? Or not say, or should they have a say in what happens to interest rates? I guess everybody's wondering.
Remember, there are two big factors that influence the economy. One is monetary policy, that's the Fed, and the other is fiscal policy, and that's the executive branch and the legislative. So if they are working at opposite directions, it's really silly because they're canceling each other out. So there ought to be, at least at the conceptual level, a sense of direction. And I think Powell has been pretty consistently wrong with his expectations of where the economy would go next.
Do you think you think President Trump will end up proving to be a friend of the crypto community?
Well, he certainly is starting out being enormously friendly with crypto. Whether some of the extreme ideas about crypto being stored in inventory by the federal government, I don't know that those will necessarily come to pass. But he doesn't start out being negative on crypto. The Democrats were trying to regulate everything, including trying to regulate crypto, but they didn't do a very good job. All these frauds that occurred came under the Democratic thing. So what on earth they think they were accomplishing with all their rules escapes me. So I think Trump, especially with Howard Lutnick being an expert in trading currencies, Scott being an expert in currencies, and crypto is a kind of currency.
How do you think he will be a different president the next 4 years compared to the prior time he was president?
Well, I think that the biggest single difference will hopefully be in terms of reducing the cost of government and stimulating the economy. And I think if using the tariffs properly will stimulate the economy. And the only way we're really going to grow out of the mess, the balance sheet mess that the federal government is in, we have to get the federal deficit down, and we have to get the growth rate of the GDP up. If you have a 5 or 6% federal deficit and only 2.5 or 3% GDP growth, you inevitably will end up with more debt. So you need both ends to be brought toward each other, and I think they will systematically do that.
One thing that will, at the end of our podcast, we love to get some sharp takes from our guests. We call them hot takes. You've seen a lot of different technologies over the course of your career, and theoretically, this incoming administration will have to have some say on AI, whether it's regulation or the power of a Google, et cetera. What do you think about some of this technology and how fast it's moving?
Well, I have two concerns about AI. I think overall it will be transformative, and it will be very good for productivity. And it's part of the reason I think we can accelerate the country's growth. There are three things that lead to rapid economic growth. One is population growth in the age group that's a primary worker. Well, that's preordained and it's very slow. The second is participation in the workforce, and that's only about 63%. Getting that up to 65, 66, 67 will go a long way towards stimulating growth. And then the third factor is productivity. And AI is going to be transformative for productivity. So it's powerful. Now, that creates a danger. One of the dangers it creates is that people may stop thinking. Just if you have a question, dial up AI.
Or to speak to a computer.
Yeah, who should I vote for president?
Yeah. Who's the best Commerce Secretary?
Yeah, who should be this? Who should be that? Because think about it, GPS is kind of a junior version of AI. And now with GPS, nobody knows how to find directions to their friend's house.
I have no clue.
People just plug in the address and whoop, we go there. Well, AI is just a souped up version and a greatly expanded version of GPS. So if people just give up thinking, then you'll suddenly have a country that's run by AI.
Yeah, which is not good.
Well, I mean, we've tried everything else.
We'll have to leave it there. It is always a treat to get some time. I should mention, too, before we go, Wilbur Ross, former Commerce Secretary, out with a new book, Risks and Returns. I encourage you all to, there you go, right on camera, to give it a read. Happy holidays to you. It is good to see you again. Former Commerce Secretary Wilbur Ross. We'll talk to you soon.
Thank you very much,
I
Brian.
appreciate it. All right, and that is it for the latest episode of Opening Bid. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Be sure to share your thoughts in our comment sections, like Opening Bid on YouTube, and hit us with those 5 stars on Spotify and Apple Music. We appreciate your support. Now, as the new year rapidly approaches, we have our eyes locked and loaded on one thing, AI. No matter what the conversation is about, we find all roads lead back to technology that has been adopted faster than the internet itself. So for today's special episode, we're bringing you key conversations on AI from 3 different lenses. Nvidia's exponential success, hype around AI startups and the enterprise landscape, and physical tech products, or IRL, as the kids say these days. First up, the market's AI darling, Nvidia. The company's stock has tripled in value this year, making it one of the best performing stocks of this year. Some of its big news, you ask? Nvidia entered the Dow at the beginning of November, booting out the index's namesake, Dow Chemical, in the process. The company has also seen brisk demand for its new AI chip Blackwell and secured the coveted Yahoo Finance Product of the Year award as a result. 22 Research Managing Director and Head of Derivative Strategy, Jeff Jacobson, joined us on Opening Bid before Nvidia's November earnings were released. He offered great suggestions on how to approach investing in the company. Take a listen. Take us through how someone like you and your background, how do you approach an Nvidia earnings day?
Sure. First we'll start with the Nvidia itself. Implied move tonight on earnings is about 8.25%, which on the surface you look at it and say, okay, it's Nvidia 8.25. It seems pretty fair. I look back the last 5 quarters, the average move was 7%, so 8% justified. However, a little digger, deep into those numbers, 2 of those quarters, you had a 16% jump in February when the stock was 67. The stock's now 147. You had a big jump in May when the stock was 95, and now again 147. So it's going to be a lot harder when you have the 120% gain since February, the 55% gain since May, to get that type of move on the number. Not to mention, at a 3.6 trillion market cap
That
now,
number's huge. Can you believe that
versus
number?
again back in February, the market cap was closer to call it 1.5 trillion in May. So the law of numbers starts to work against it. Now, I'm not saying that the stock can't have another big move, but when you have a $3.6 trillion stock and you've had the success that the stock has had year to date, it just gets harder and harder to keep kind of getting higher, especially when the bar is raised where it's been.
So you're sitting at your desk. How do you approach Nvidia? Because I think a lot of folks, when they go to Yahoo Finance, they see Nvidia, they'll look at P ratios, they'll look at multiples, they'll study earnings and profit trends. But I imagine, given your trading background, like you approach it a different way. Like, what screens do you set up? Like, what does that look like?
Yeah, I mean, I look at volatility for, that's my go-to, and kind of, like I said, I'll look at the implied move first. I'll look at what the stock has done in the past, and then I'll look at where, not just where the weekly vol, the at-the-money straddle, that's again 8.25% move, but I'll look at further months as well. And then from there, I'll kind of dictate, to myself, what's the best trade. So that being said, I'm kind of not in favor of buying expensive weekly vol here, again, just because of the size of the company. It's getting harder to move. Unless you really think it's going to have a dive, you probably want to stay away from expensive vols.
Are you a big chart guy? And I ask that because if you go back and look at Nvidia's chart, at least on Yahoo Finance, let's say 6 months, I mean, the stock hasn't moved a lot since, late summer? Like, what does that tell you?
I mean, yes, it hasn't moved a lot, typical for the move everyone expected Nvidia, which was, just gain after gain. But I think that draws me into one of my ideas. We'll get to that in terms of the SMH. When you look at the entire semiconductor complex, that's really been, down.
It's been down.
Decimated.
I mean, you look at AMD, you look at, I think it was Qualcomm, all these, AMD's really been
the semiconductor equipment companies, AMAT last week got hit pretty hard on earnings. So I think the strength in Nvidia, trading basically at the highs, is masking some of the real weakness we've seen. Now, you can argue Nvidia AI play, the other companies are more levered to industrial, the phones, computers, what have you. But because Nvidia is such a high weighting in the SMH, it's really masking, I think, the weakness that we've seen from other parts of that group.
Then does an Nvidia investor, these people, we talk to these folks all the time, they love Nvidia. They are obsessed with Nvidia. I mean, the stock has made them a ton of money the past 5 years, even the past year. Should they be taking more of their cue right now from the weakness in semiconductors more broadly? Are they what I'm trying to get to is semiconductors suggesting something brewing for Nvidia?
Yes, but the argument that I think the bulls will have is say, well, it's a different industry, the AI growth, the capital spending that we're seeing from the major companies. So maybe we are seeing that spread between Nvidia and the rest of the complex is deserved because of the growth and the money going there. Not to mention, probably as we see weakness in some of those other semiconductor names, the money will funnel towards what's working, which is basically Nvidia in that space. So I think it's going to be more of an if-then. We'll see how the earnings play out. If the earnings disappoint our guidance or the expectations were too high, then the bears will say, see, the other semiconductor stocks were signaling that. And if it's bullish, then the bulls will argue, see, we shouldn't be kind of grouped in that same category, which is why the earnings, again, are always important.
Do you sleep the night before an Nvidia earnings? Like, I mean, do you get nervous about some of these calls? This is like.
I think it's more. I think it's more excitement that, I mean, this is what everyone in the market wants. It's the action. It's trying to forecast it. My job is to look at purely the vol component and make an assessment. Is vol rich? Is vol cheap? One other trade, going back to Nvidia, I think.
Keep them coming. This is great, man.
I wanted to point out, I mean, everyone loves Nvidia, and for good reason. It's probably been the main reason.
It's printed money. It's been like a CD, except this CD pays 30% every time it reports earnings.
Right. If you've owned it, you love it. An interesting dynamic Nvidia that I wanted to point out, not so much in the weeklies, but if you go out longer, is upside calls are expensive to puts. Probably a function of some of the gains we've seen on earnings. Maybe it's a function of the FOMO of I don't want to miss the upside. Maybe you're seeing people sell some stock and buy calls as a replacement. Whatever the case is, I looked in December, and the upside call in Nvidia is trading at a higher vol than the puts, meaning stock closed at 147 yesterday. As an example, the 160 calls, 13 points up, are trading at the same price as the 137 puts, 10 points down. So that's giving you an idea of the favorable skew, if that we call it, where calls are rich to puts. If you are nervous and you own it and you still want to have upside, but you want to have that downside protection, that's a really interesting trade because you still have some upside, almost 10%, if you sell that call against your stock and buy that protective put. And it trades for even. So the stock does nothing, there's no harm, no foul. If you get a move lower, then you have that protective put at 137. The stock was 138 on Monday morning. So we can see and have seen volatility. And it doesn't mean necessarily you need to even sell that 160 call. You could sell a higher strike call. It would trade for a debit. But again, knowing that calls are expensive to puts, stock's up a ton this year. It's at the highs. This is the weakness we saw in semiconductors. So that's another trade, speaking specifically on Nvidia, that I think as a collar or a protective collar, it's a really interesting setup.
I just got a mention in my ear from our fabulous producer. Can you define a put and call for the average investor?
Sure. So a put gives the buyer the right of the put to sell the stock at that price. So let's go back to the Nvidia trade. The 137 put means if the stock goes below 137, you get the right to sell the stock at 137. So if the stock goes to 125, you sell it at 137, you make the $12. And the call is just the opposite. It gives you the right to buy a stock if you own the call at a price. So if you bought the 160 call and the stock was trading above that, you effectively make all the money above the 160 strike where Nvidia is trading. So you buy it, you're effectively buying a 160 call at the stock trading 165, you effectively buying it, own it $5 cheaper. That's your profit.
That was 22V Research Managing Director Jeff Jacobson on Nvidia. More of our special AI roundup coming to you after the break. Welcome back to Opening Bid, peeps. Next up is AI overhyped. We evaluated the landscape of startups and enterprise-level AI companies with C3 AI founder and CEO Tom Sizable. Sizable is an OG in tech, so his views have gravitas. In no certain terms, he explained why AI is overhyped, calling out many founders for thinking that they're creating God in a box. Check it out.
When I connected with you in January of this year, I mean, there was hype around AI. Everybody with the World Economic Forum and Davos was talking about AI this, AI that, AI risks. But wow, I mean, since then, things have really gone through the roof. I mean, how do you see it from your vantage point?
Well, there's as it relates to kind of the AI writ large, I mean, this is a secular change. This is not ephemeral. It's a genuine big deal, probably a, couple $1 trillion addressable market. I mean, this is big, or a couple of, $1 billion addressable market. But what's going on with generative AI right now is it's getting pretty frothy. I mean, this is an important technology. It solves some very real problems. For those who are interested, I've been looking for a good book on this subject for the last couple of years, and somebody finally wrote one. A guy named Stephen Wolfram, who is a kind of very important member of the Academy of Physicists from Caltech, wrote this book. What is ChatGPT doing and why does it work? Well, it's really not ChatGPT. It's about these large learning models, okay, and generative AI. And he describes in the first 51 pages, it takes about an hour to read, exactly what these things do, the small class of problems they solve. He talks about the randomness and stochasticity and hallucination, and importantly explains that those of us who develop these things, I mean, even we can't explain how they work. I mean, there is voodoo involved, but this is a good book. But kind of let's look at generative AI writ large, like right now, in October 2024. I mean, it's crazy. Now they say that markets can remain irrational longer than a rational investor can remain solvent, and I think we're in one of those situations. Is this technology important? It's hugely important. Will it solve real problems? Yes. But I mean, come on. We have a company that's losing, what, $10 billion a year that just got financed at $150 billion valuation. $150 billion, if I'm not mistaken, that would be order of like Shell, which is one of the largest companies in the world. That company, OpenAI, it could be gone next Monday. Okay, very high probability. Nobody would be surprised if you read, and if you gave a report next Monday, you read the Wall Street Journal that OpenAI had folded its tent, and if it were gone, nobody would notice. I mean, the world wouldn't change a bit.
Let me add.
We have hundreds of companies being financed at multi-billion-dollar valuations by my friends on Sand Hill Road, where people are. We have 3 people out of Stanford or Illinois or Wisconsin or whatever it is who are, starting, who don't know anything about law or medicine or dentistry, and are starting, generative AI companies to use a language model to assist lawyers or dentists or, divorce lawyers. I mean, hundreds at multi-billion-dollar valuations. We have people at these companies, leaders of these companies, I won't mention names, you know who they are, who actually think they're building God in a box. I mean, you can't make this stuff up. I mean, God in a box. I mean, really? So, there's all this yap about, sentient computing. These AI models are going to, your smart refrigerator is going to take over your house. I mean, this is truly insane.
Tom, I love that you've come out firing today on this hype, and it's important because. Investors are seeing these stocks go up every single day, it seems like, because of AI hype. But let me lock in on ChatGPT or OpenAI. So you're the expert in this field. Are what they doing not unique?
Of the various language models that we're using, which is all of them, I mean, right now, ChatGPT has the hot ticket. I mean, they have the most useful language model that's out there. That being said, we have Google, Facebook, Anthropic, Mistral. These people are spending billions on out innovating one another, and it's so there's no telling where this is going to end, and there's no reason to believe that one of these guys is going to win. I mean, this is just not that hard to do, and we could have the next company coming out of the Bronx or Cambridge or Shanghai or Palo Alto that nobody's ever heard of that turns out to be the leader in the space. It's really exciting area, lots of innovation. Make no mistake, these things are useful and they will change our lives in important ways.
How do you see all of these very big companies that now are getting these very large valuations? I mean, how do you see that? What's the end game? Like, what is their collective impact going to be on the internet, on the enterprise?
Well, this is, the market, when it sees, important innovations, it tends to overvalue them. Be it transcontinental railroads in the 19th century or urban electrification in the beginning of the 20th century, which brought on the Great Depression. The dot-com era in, like roughly 2000. Now, was the internet overvalued in 2000? I mean, no way, no how. Whoever thought, whoever had the biggest numbers, 3 orders of magnitude larger than that now. But these market tends to, when there's something important happening, and this is important, it tends to, kind of irrationally overvalue these things, and then it resets by 10 or 15 or 25%, and we get on with the game. And when that reset happens, we have a couple thousand companies go out of business, and that'll happen here. I'm not calling the top. These things can go, these can go on for a while, and this might go on for a while, but it's pretty frothy. You get to generative AI, it's pretty frothy. Now, people are conflating, generative AI with the use of kind of meat and potatoes and social media AI with what C3 AI does, which is a little bit different. So we're involved in kind of meat and potatoes, run the business, supply chain optimization, production optimization in oil wells, smart grid analytics, contested logistics for the military, predictive maintenance for the Air Force. So what we're doing is a little different. We're about, companies making money, saving money, increasing productivity. So we're a little bit grounded. It's just kind of old school stuff. We're not doing God in a box.
Though we all know Nvidia, ChatGPT, and Tesla, it can be hard to imagine other real-world applications of AI technology. So for the close of our episode, we wanted to help you ground all of this in the real world. Coming at you back-to-back is the Citi Global Insights team with their newest research on, yes, humanoid robots, as well as the iconic Property Brothers talking about AI infiltrating your home. Enjoy. At some point, I may have to care for my aging parents. And it's something I've never done before, but maybe I just program this humanoid and let them take care of them. We're at the point where these robots could actually lift humans, and what does the AI look like here?
Well, the AI is a really important facet because, as I said, robots have been around for years, and we went from industrial robots to cobots, and things behind cages to things were whizzing around factory floors or warehouses, whatever else it might be. But in terms of making them useful for lots of different noisy environments, AI has now developed to a point where actually we can have a conversation using natural language processing previously, and now large language models and foundation models to be able to have a two-way conversation. You can take that and put it into coding to be able to codify the actions that you want them to be able to do. They obviously are able to see, and I think it's pretty remarkable, just as an example, and you take a step back. We wrote our first Car of the Future report in 2014, thinking about autonomous driverless vehicles. And yes, it's a long time coming for different reasons like safety and regulation, etc. But the reality is you can now have moving robots going at 70 miles an hour around the streets in certain places. So it's not too much of a leap to think, well, if you can move from there to be able to move to, less noisy, easier to navigate environments, that they can be very useful. But this AI component is really critical. And one of the things people talk about in AI is now we have the ability to have multimodal AI. So rather than just discrete units of this is great at vision, this is great at language, etc., this is great at coding actions, you're able to then bring them all together. And that's what turns them from, quite frankly, being potentially more useless to being more useful.
Wenyan, your $7 trillion market potential note by 2050, what are some of the challenges to reaching that? I imagine manufacturing robots on this scale might be one of them.
Yeah, exactly. I think one of the challenges is that we don't have the scale of production right now. A lot of those parts for those humanoids, for those humanoid producers, they're just 3D printing all of the parts. I think one of the hindrances would be we need to build the production line for that, and also the way that I like to think about this is that AI is the brain of humanoids, and then we need to train the AI in the real world in order for them to learn how to perform specific tasks. And in order to train them, we want to have the data for them, but we are running out of data. Data is really important. I think a lot of so one of the infrastructure that you can invest in is data centers, because it really powers the training of AI. So data would be one of the barriers, and now is currently roughly 20% of human efficiency. and it still continue to learn. It developed really fast, but we need some time in order to get to a world where the efficiency of humanoid is like 100% or 200% of human to reach that substitution ratio of 1:1 to 2:1.
You mentioned, Wenyan, in the report that one of the biggest opportunities for humanoids is, well, I'll list them here. It's home services, industrials are key, delivery. Why home services? Like, what do you think a humanoid will end up doing?
I think the biggest area for is really home services, is because we've got a huge number, 3 billion households in the world, and based on the survey that we saw, 70% of the homes in the world they're potentially willing to adopt. But obviously there are differences by development in different areas. So we segment the geography into more developed areas, less developed areas, and least developed areas. And we apply a very conservative number for the, even though we apply a very conservative number, we still get a very huge unit number. So what they can do is they can do a lot of things. You've already got the robot cleaner in your home mopping your floor, and they can do the laundries, they can make you a cup of tea, they can mowing the lawns, and they can take care of the elderly people that you don't need to send your grandparents or parents to the care home. You can just take care of them at home. I think this is one of the biggest use cases, actually.
That's just I just program my robot. They can take care of my mom or dad. They can just serve them food. They can call them. Maybe because I don't have to call them. Maybe you can't even do that.
There's so much tech that you can control from your phone that keeps every aspect of your home safe, whether you're home or not.
On the cool side, I just saw technology, and I know they've been working on it for a while, but it's first going to hit like the media space, and then it'll come into the residential space when it's affordable that way. But it's 3D color. It's 3D television basically without the glasses. So you're basically watching a TV and it's full 3D coming right at you, and they call it solid light. It's pretty cool. So technologies like this, imagine having a fireplace. It's an electric fireplace, so there's no hazard, there's no CO2, no issues that way, but it literally looks like a real fire in your space and you still get the heat.
You know what I'm interested to see, because I've seen a little bit of this, but it's not quite there yet for the average consumer. But because a lot of people are trying to live in a smaller space that's more multifunctioning. Sure. It can be multiple rooms, or you see like in Japan they have like a one room that the toilet comes out of the wall, and the bathroom, the kitchen, everything's in one room.
The toilet comes out of the wall?
Oh yeah, like it's a panelized system. So if you look up online, you'll see it.
You got a real focus on toilets over there.
Yeah, I'm taking it all in, guys.
Toilet notes.
I only get like a finite amount of time with like guests, especially you guys.
But this is the thing. I don't like the idea that you have this tiny room where your kitchen sink and your toilet are right there together. However, what I'm looking forward to seeing is how they have larger rooms that do adapt the room. If you want to entertain guests, it manipulates the walls or moves the walls so you have better space for a dining space, and then it can shrink down and give you a second bedroom or whatever you need.
You know what's wild is you do actually see a lot of incredible innovation come out of Europe or come out of Asia when it comes to tiny spaces, because they're dealing with a different type of housing over there. Well, you mix that now with the AI technologies that are coming along. Drew talked about leak detection earlier, which I think is incredible, because you can have AI-driven leak detection so that if something's happening, there's a flood at home, you're not responding, it'll automatically turn off your water. But again, talking about seniors and aging in place, you can also adapt that technology so it says, hey, somebody who's living in this home hasn't used any water all day, you might want to check on them. There could be a problem. So I love the fact that we're seeing now all this great innovation, all this great technology merging into what will be a much smarter home.
And price coming down on that too.
This is your latest episode of Opening Bid. Once again, be sure to hit us with those likes, follows, and subscribe wherever you get your vodcasts. Happy holidays, everyone.
Hello and welcome to Market Domination. I'm Josh Lipton alongside Brad Smith, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
Good afternoon, everyone. We've got 1 hour to go until the market closed here on this holiday abbreviated trading session, and we're taking a look at the major indices with that time that we have left. The Dow, the S&P 500, and the Nasdaq Composite all holding on to gains, hoping that this Santa Claus rally commences today, and we're seeing a bit of that starting up here as we've got green across the screen. For the Dow, it's up 0.5%. Nasdaq Composite adding on 1% today, and the S&P 500 adding on 0.75%. Also want to take a look briefly, since we mentioned that outsized move in the S&P 500 and the Nasdaq. For the S&P 500, it's XLY, some of that consumer discretionary really pushing things higher today. That's up by about 1.6%. And then you've got a sea of green here. All 11 S&P 500 sectors in positive territory right now. And Josh, we've been tracking this throughout the day with technology, seeing some big gains for mega cap tech stocks.
Yeah, some pops there. I mean, trading relatively quiet today, Brad, as you would expect ahead of Christmas. Trading equities ends around 1 p.m. Eastern, as you noted. Investors hope for that Santa Claus rally, right? Stocks climbing the final 5 sessions of the year, the first 2 of the new one. I do think big tech, look at some of these gains today, including Amazon, Nvidia, about 0.7%. That has been the place to be. Still your key leadership group there.
Yeah, and for those of you who are cruising around trying to do some last minute shopping in your cherry red Tesla perhaps out there, you're seeing that move higher by about 5% on the day too. The market's starting the Santa Claus rally period with gains, and we're an hour away from the close on this holiday shortened trading day, and stocks near the highs of the day. Our next guest here has a look at what will really matter to the markets in 2025, and they say it's all about inflation. Joining us now, we've got Alex Morris, FM Investments President and Chief Investment Officer. Alex, thanks so much for taking the time here with us today. So why is it all about inflation from your purview?
Well, I think it's all about inflation because everything we see in the market is telling us that. We see that in the long end of bonds pushing it that way. We see that from policy, right? No matter who you voted for, both candidates were running on very pro-inflationary policies. And it looks like we're definitely going to get that. And a lot of folks have been looking for inflation protection in sort of all the wrong places. Equities have done well, but that's been a mixed bag of some support. You were better off buying gold, given where the S&P and gold have done this year. But on the same token, commodities have really let folks down as an inflation hedge. So now folks are left wondering, where are they going to go? And we think that's much of what the conversation in the first quarter of the year is going to be about.
And what's your answer to that, Alex?
Although we say this at the risk of folks saying, hey, but they ripped my face off the last couple of years, we think a better way of managing tips is the answer. The government has a bond program that just puts it right in the name, Treasury Inflation Protected Series. A lot of folks bought tips. They bought the mid or long curve. And when they did that, duration cannibalized all of their actual inflation protection. You're going to see us come out with some products in the first part of the year that are going to help investors really avoid the duration, but pick up all that CPI protection that tips offer.
That's particularly interesting. And so as you think about the protection that is necessary, how can investors really make sure that their portfolio does protect against any volatility that comes forward with future economic data prints that might continue to rattle what the markets have already been rattled by, which is a Fed that is putting out potentially less cuts than were expected next year?
So the simplest answer, we think, is T-bill and chill. We offer TBIL as an ETF. It's the short, super short end of the curve. It's the 3-month on the run, most liquid version of a cash bond that you're going to get. And we think folks have done pretty well there. You're still getting a 4.3% return. If rates stay where they are or just have 1 or 2 cuts, you're still going to likely see a 4 handle on that. That's a great place if you're uncertain. Let's not forget, 5 years ago, 4% was a dream in bonds. Now folks are complaining and lamenting it's not 5 like it used to be last year. But we think that's a great place to go. We're going to give some folks some opportunities next year to be in the shorter end of the tip space and a better way to manage that. That will be easier to access, easier to understand. But otherwise, we still think there's a real opportunity in shorter term investment grade bonds. Although you're going to see some rate movement that would impact principal, reality is coupons are pretty good. Most of the return you're getting in a product like Z2 or Z-Tray are giving you current income from mostly coupon, as opposed to bonds that are aged where you're just kind of hoping that price movement works in your favor. And we think investors are doing pretty well. You're going to earn 50 to 80 basis points over current treasuries for that. And you're going to be in the investment grade space where we haven't seen any issues, even threatening issues at all in delinquencies. So I think that's a great space to be. You can still clip a reasonable coupon and then some, and have a little bit of, protection when rates come down. You're going to still get a little bit of an upside tick.
Alex, with the 10-year back above 4.6 here, how much of a challenge is that for that is that for the stock market? Does that kind of represent critical resistance to you?
4.6 seems to be a resistance point. We've seen flirting with 4.7 from time to time. We've seen in the last couple of years, anytime we flirt with 5, the market comes in and just stops it from going above it. Seems to be an insatiable demand for anything above 5 on the 10-year. I think the stock market, though, is probably wrestling with the same thing the bond market is. The 10-year is going up because of fears of inflation that have yet to be realized. They could be less than we're pricing in, which would say maybe that the rates rally was a little overblown. They could be, we could be underpricing it by a pretty healthy margin. We just don't know, and we're not going to know until after January 20th where that's going to go. From a stock market standpoint, if we look at the names that you just had on the chart that were going up today, right, Tesla and whatnot, these names are largely insensitive to long-term rates, right? They're not going to the market borrowing at the 10-year plus or minus. They're borrowing against the fact these are super profitable, strong companies. So I think as the stock market wrestles with it, you have to ask, what's the return you want? That's why we like U10 and the ways that we keep folks on the run in the 10-year. You're still clipping a 4.5 coupon right now. So if you do that and just keep reinvesting to the new on the run, you're going to continue to get all of that upside benefit when rates do come down. But you're investing at a rate where you're not actually losing ground when rates move from 4.5 to 4.6 to 4.7.
I mean, I know what kind of returns I already want, Alex. I want my returns to be merry and bright, but that's not the case from what some of the analysts and the strategists this morning even were telling us in anticipation of a potential correction, even though we would see broader gains in the long term in 2025. What's your outlook on that? Could we see a sharper pullback prior to hitting some of the larger S&P 500 targets that we've seen larger strategists at institutions forecast for next year?
I have to remind folks that 85% of strategists were calling for a pretty profound recession in 2024. And unless we're going to be really surprised in the last few trading days, I don't think we're going to see that. So, and even Chair Powell made pretty clear that for all of the forecasters, including the Fed's own, none of them seem to get this right ever, to paraphrase at one of his press conferences. So I think there is the opportunity for that correction. Things are getting a little frothy, it feels like, but valuations aren't insane yet. We're not anywhere close to where we were in the dot-com crisis, particularly for the big tech names. So there's no need for that. But some of these corrections now come a lot like runs on banks. They don't happen because there's an actual issue. They happen because folks are afraid there'll be an issue and everyone wants to get out first. So I wouldn't be surprised if we saw a little volatility in that and some repositioning as the indices have now realized they have a concentration problem and they need to rethink how they position those names. That's going to add some volatility to the market, and that's going to, I think, create a little opportunity for that correction. But long term, these companies, again, are superbly profitable. They're meeting or beating expectations. They're meeting or beating those whisper numbers that are above reasonable expectation. So there's no reason to expect a stumble. The consumer is strong, right? 2/3 of the U.S. economy is consumer oriented. We're still spending, apparently. It seems to be a good Christmas if you look at the Amazon boxes up and down the streets here in DC. So I think, net, those numbers are maybe a little bearish. I've seen some analysts asking for 3% over the next 3 to 5 years in the S&P 500. That feels weak. That 8% might be a little optimistic, but somewhere in between feels like that might be the Goldilocks scenario and probably what Jerome Powell and the rest of the crew at the Fed are trying to target.
All right, Alex, great to have you on the show today. Appreciate it. Happy holidays.
Happy holidays. Thank you.
Major banks and business groups sued the Federal Reserve over its annual stress tests. And here with the details is Yahoo Finance Fed correspondent Jennifer Schonberger. Jennifer.
Josh, a consortium of bank lobbying groups is suing the Federal Reserve, alleging that the central bank's stress tests are too opaque. They say the Fed is in violation of the law because the Fed does not give the public the ability to weigh in on the stress test process as permitted and required under federal law. The stress tests were mandated annually by law after the financial crisis for banks with $100 billion or more in assets. They examined whether the banks have enough capital on hand to continue lending to households and businesses during a hypothetical severe recession to prevent bank failures and future crises. Right now, the Fed offers some details on how it conjures its stress tests, but banks still feel they are in the dark and have to guess to ensure they have enough capital on hand. They dictate these stress tests how much in dividends and stock buybacks banks can give back to shareholders. Now, the plaintiffs include the Bank Policy Institute along with the American Bankers Association. Rob Nichols, president of the American Bankers Association, said in a statement, quote, "The opaque nature of these tests undermines their value for providing meaningful insights into bank resilience. To meet federal law, the Fed should publish the supervisory models and stress test scenarios and invite public comment." Now, this lawsuit coming just a day after the Fed itself announced on Monday it will soon seek public comment to improve the transparency of its stress tests, the very issue that banks are suing the central bank over. Specifically, the Fed said it will propose disclosing all of the models that determine the hypothetical losses and revenue of banks under stress and ensure that the public can comment on the hypothetical scenarios used for the test before those scenarios are finalized. So why bring the lawsuit now? Well, the statute of limitations is set to end in February 2025, and the banks wanted to retain their legal right to challenge the stress tests in court. When I asked the Federal Reserve for comment, they said they did not have anything for me at this time. Back to you.
All right, thank you, Jennifer. Appreciate it. And we are just getting started here on Market Domination. Coming up, we're setting you up for investing success in 2025. Stay tuned for which names in transportation are worth adding to your portfolio, according to a Bank of America analyst. Plus, find out what's driving the top trending tickers on Yahoo Finance. And as investors brace for a higher for longer rate environment, could a rate hike be on the table next year? We're going to discuss all that and more when Market Domination returns. Automakers Honda and Nissan officially confirmed the companies are exploring a merger, but our next guest says a failed deal could leave the two Japanese companies weaker. Carl Brauer, ICCars.com executive analyst, joins us now. Carl, it's good to see you. So a merger, Carl, between Honda and Nissan. High level, broadly, Carl, does that make sense to you strategically?
It does make sense. Honda has been one of the smaller players on the global automotive market for most of its existence, and that was okay. It was innovative enough and had enough really impressive product that it could compete and do well. But the market has just gotten so brutal. The low-cost Chinese cars that are coming in globally and are really challenging everyone else, the shift toward electric vehicles and the cost and R&D required there, it's putting smaller players like Honda at a disadvantage. So they have been partnering somewhat. They've been working with GM and some others on various projects, but they really need kind of a permanent dance partner, as we say. And I think Nissan makes sense for them.
What type of production synergies make this deal make sense, and what is the timeline that they would have to come forward on in order for it to make a true dent in how these companies are able to compete at an even better rate and clip versus some of the other car makers and automakers in the industry?
Well, they've each got a buyer base that's substantial, and if they're together, they're going to have the third largest global automaker in sales. So that's a pretty substantial shift for both of them in a positive direction. There's a history of Nissan having electric vehicles. They were one of the first to move with the Leaf about 15 years ago. Many people think they kind of dropped the ball. They should be further along given where they were 15 years ago. But the bottom line is they've got far more electric vehicle experience than Honda does. And I think with Honda's engineering and innovation capabilities, along with Nissan's history and current experience with electric vehicles, the two together could probably move pretty quickly and make things happen. So I think that's a good thing. And there's also like the full line thing. Honda doesn't really have like a full-size truck. Nissan's got one. It hasn't been as successful as it should be, but I think, again, together they might come up with new products that between each of their capabilities, they could be more innovative and more kind of market competitive and even dominant.
Carl, let's switch gears here, talk about the U.S. market. Trump moving back into the White House, Carl. What is a second Trump administration? What does that potentially mean for the American auto market?
It's going to be an interesting time frame for sure, probably pretty disruptive. We've seen a lot of energy put into the electric vehicle transition and a lot of emphasis on getting us there as quickly as possible, probably faster than the market really can manage. There's just not the level of consumer demand. We're already seeing electric vehicles stacking up at dealerships, not selling as well. The growth curve of electric vehicles has really kind of plateaued. And at the same time, we've now got this new administration coming in, and they're almost assuredly going to remove the $7,500 federal tax credit and reduce that steep EPA requirement of MPG and CO2, MPG gains and CO2 reductions. And all of that happening should really be shifting and is already shifting automakers' product plans. We're seeing shifts in which vehicles are coming out first and delaying specifically electric vehicles and substituting hybrids in, like what Ram's doing with their full-size truck. Volkswagen, a lot of these companies are starting to already shift their EV product kind of into the back plan and moving forward with more internal combustion and hybrid vehicles, which is, I think, smart.
So as you're kind of looking out into 2025 and really factoring in where we could see even more demand potentially here for hybrid vehicles as consumers want some of that optionality here, which car maker is clearly far and away the best position for the hybrid demand that we could see come forward?
Well, as is often the case, be like Toyota. Toyota just has navigated so well through all the different shifts that happen in the automotive industry, both nationally here and globally. And once again, they never went whole hog into the EV space. A lot of people were yelling at them about that. Where's your EVs? You aren't competitive. You're falling behind. And they always had a great answer, which was essentially, we're not putting a lot of resources into a bad business model. And we've seen all these other companies spend a lot of money on EVs and lose a lot of money on EVs so far. And Toyota has really pioneered the hybrid thing for over 20 years. And they're very well positioned now to take advantage of consumers looking to get better fuel efficiency and maybe even drive on pure EV with plug-in hybrids for a certain distance, but not commit to a pure EV where there's range anxiety. Toyota's right there. And we're watching the other car companies quickly move that way too.
So Carl, we talking about EVs and hybrids. I'm also curious though, trucks, pickups, Carl. What does demand look like that in the U.S. market over the next 12 months?
You know, we're a truck company, a truck country. And so it's going to be tough to ever really kill those truck sales. There are just so many uses for them here, both commercially and privately. People love their trucks. But I think the Dodge Ram and their range extender version that's coming, the Ram Chargers, they call it, great name, is really brilliant. The idea that you can travel indefinitely on an electric motor, but you have an onboard internal combustion engine to continue to power that electric motor and make sure you never run out. That makes a lot of sense. And when I saw it, I thought that this is brilliant. And we're going to watch how quickly the other full-size truck makers, GM and Ford, struggle to catch up. And guess what? Guess what we're hearing from both of them? Oh yeah, we might try to do some kind of hybrid thing, plug-in hybrid thing with our trucks. So that's really the way to go, because as soon as you load up an electric truck, you kill its range by 20, 30, 40, 50%. And you kind of lose that same percentage if you have a diesel truck. The difference is you go pull into a gas station and you solve that problem in 5 to 10 minutes. You don't do that when you're an electric truck towing a big trailer behind you or hauling a lot in the bed, and then you run out of energy. It's a lot tougher problem to fix as you're driving.
I just want to see how well these pickup trucks and these trucks crab walk, quite honestly here. It's a scary sight to see in commercials, but in real life, it's got to be even worse. Carl, thanks so much for taking the time here with us. Really appreciate it.
Great being on with you guys. Take care.
Likewise. Now time for some of today's trending tickers, and you can scan the QR code below to track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Let's check in on shares of American Airlines. This has been a hot ticker symbol here on the day, ticker symbol AAL. Just hours after an hour-long ground stop halted flights nationwide. In a statement, American Airlines said a vendor technology issue briefly affected flights this morning, and it's all hands on deck as our team is working diligently to get customers where they need to go as quickly as possible. There you were taking a look at shares on your screen just a moment ago here, still in the red, but ultimately here off of some of the declines that we had seen as this was unfolding early in the day and even pre-market here.
Yeah, it sounded like still, Brad, we still don't know exactly what the technology issue is, still unspecified. Reports noting American had about 3,200 domestic flights and around 580 international flights scheduled for the day. I mean, obviously, we know this is a really busy time of year. American did say in a statement that they sincerely apologize to customers for the inconvenience this morning.
Yeah, some of the other, of course, contextual data around this is just the sheer rise year over year in the number of travelers, too. We are already seeing a rise of about 5% in setting new records for TSA traveler throughput this year in 2024. And so that is something that is noteworthy, especially with the influx and the surge of travelers anticipated over this extended 10-day period, we'll call it, over the holidays.
Tough day for that headline. All right, plus Netflix, let's get a look at that one, because getting a price target raise over at KeyBank. Analysts up their target to $1,000, cite several reasons they believe Netflix can outperform the broad market next year. So they did raise the target, they get to $1,000. They maintain the overweight rating. Tremendous year for this name, right? I mean, the stock's up around 90% in 2024. The several reasons they called out to their clients where they think Netflix can outperform the broad gauge into 2025. They talk about competitive intensity is moderating. They say live events should drive more engagement. Revenue and EPS growth should hold up better than peers. And they talk about how meaningful EPS and free cash flow generation provides, they argue, more of a valuation floor than in the past. So buy, target 1,000.
Yeah, just as long as we don't have to see any more of Mike Tyson's butt on Netflix
no one wants
any of these live sports experiences. We're going to get some NFL games, though. Men in tights running around, and we'll see how that performs. Of course, we also got a Beyonce concert that's going to be taking place, too. We'll see if that also gains some fanfare, some additional viewership.
Those are some good games, by the way.
They are good games.
Chiefs, Steelers. Ravens, Texans.
Are you a Ravens fan? You got a lot of.
I'm a Bay Area guy, man.
Oh, really?
49ers.
Yeah.
Eagles.
That runs
You're
true.
Eagles.
I am Eagles, yes. Go Birds.
There you
We got a lot of injury-prone teams over the course of this season, so hoping that we don't see any major injuries come forward on Christmas Day. It sounds like Lamar Jackson, for his own right, he's going to be staying out to watch the Beyonce performance. He already said, I don't care what Jim Harbaugh has to say about it, but we'll ultimately see what the performance and the measurement looks like for Netflix coming out of those games, and see what this ultimately means for their strategy and investing further into sports as well. Golf, a fight between Tyson and Paul, and then now NFL, and we'll see even more how the documentaries get leaned into.
Yeah, it's so interesting, the knock-on effects, Brad. What does it mean for advertising? What it means for new subs?
Spot on.
And then if you get new subs in, how good are they at retaining those subs?
Attention, We're going to be watching that closely here with NFLX. And finally, we're tracking nuclear stocks. One of the beneficiaries of the AI trend, a few names like Oklo and NewScale have rallied more than 100% in the past 12 months, boosted in large part by partnerships with big tech. So what will the new year bring for the sector? We spoke with Mark Nelson, Radiant Energy Group Managing Director, earlier, and here is what he had to say.
2024, huge year. It's like the whole world discovered nuclear. The way I'd put it is, everything kind of became about AI, and AI became about energy, and suddenly people realized that the tech players did not have a realistic energy growth strategy. They said they were using 100% renewables when they were just going off the grid. Well, they ran out of grid. So what we're looking at now is a 2024 where the biggest banks, a bunch of the world's countries, all made commitments to saying, we love nuclear. That's not the same as building nuclear, and 2025 is going to be the year of show me.
'25 could be a year of transformation for the transportation and logistics industry here, with AI advancement, looming tariffs, and potential port strikes on the horizon. Joining us now, we've got Ken Hexter, who is the Bank of America transportation analyst. Ken, great to have you, and thanks much for taking the time here. What are some of the top trends that you're anticipating for the sector next year?
Great. Happy holidays, and thanks for having me on. What we're looking for, right, is we've been in an elongated freight recession. We've been in a freight recession for about 2.5 years now. We're starting to build out of it. We're seeing enough independent small mom and pop truckload bankruptcies that have cleared up a lot of the excess capacity that's been around since the COVID loans that has kept too much capacity. But it really comes all down to demand. We haven't had demand really drive an upward tick. So while we're getting rid of some of the excess capacity, what we're really looking for in 2025 are signs that demand will start to build, because in an industry that doesn't make anything, that just moves stuff, getting more stuff moving is the key. And so we're going through a holiday season, a little bit of a slow start. We haven't, really broken records. We didn't really see a lot of project business, but if things are starting to build, we're starting to see spot rates increase, and that at least sets us up to the start of 2025. Again, over the last 2.5 years, we've had a couple of head fakes. You want to see that demand continue to build, and that will drive a lot of stuff in transportation.
Ken, let's dig into some specific names here. FedEx, name you cover, name you like. Obviously made headlines, plans to spin off its freight division. Ken, in your opinion, as an analyst, and you know the name backwards and forwards, was that a smart move, Ken, financially, strategically?
Oh, this is a huge value unlock for FedEx. This is something that I think the street has wanted to create value, and the company is midst of a $6 billion overhaul on their cost side, as they first they cut costs at FedEx Express, Federal Express now, and then they go in and merge their ground and express divisions. Right now, they had two separate divisions, one that would drive your local residential ground package, one that would deliver express packages. So you could have two drivers showing up from the same company. They're in the midst of combining that by 2027. So that's a multi-billion-dollar cost savings. That's where you want management focused on. And then they've got this freight segment, this less than truckload segment, which is the largest provider in the less than truckload industry, about 20% of the market. Not too much overlap. Obviously, there's a lot of contracts from customers, but again, everything that can be dealt with. This is going to be a huge value unlock for FedEx as they are allowed to then spin that off and to the equity markets and then focus on their core business.
Yeah, for the freight side, they talked about that on the call with regard to the operating profit increasing nearly 25% on average per year over the last 5 years. Are there additional investments that you would need to see FedEx make in order to further solidify the lock-in of that operating profit growth here? And how should investors really evaluate when those investments from FedEx and that CapEx really comes into the fray and is proven to be successful into their financial performance?
Yeah, so as an independent company, or as a combined company, they had blended their sales force. So FedEx Freight was sharing the sales force with Federal Express, the express and ground segments. So that's the one investment that you're going to have to see them really spin out. They talked about adding 300 salespeople before they prepare for the spin. So that's something you're going to have to get up and running. As far as the investments go, there's not facility-wise. They are, as I mentioned, they're the largest less than truckload company with about 20% market share. So they kind of already have the facilities they need. They can continue to invest for growth over time, but the sales force is the one thing they're going to have to do independently to kind of before they get ready for that spin.
Ken, I'm curious, you like FedEx, not as enthusiastic though about UPS. You're on the sidelines there. How come, Ken, and what would it take to get you more bullish on that name?
Great question. We've actually been more neutral on UPS since about April of 22, when we downgraded a lot of the transport names as we started into what is now been one of the longest freight recessions that I've been around for in over kind of quarter a century here that we've seen in terms of tracking the freight market. And so we're kind of stuck in this malaise. And in the opening comment, we talked about what are we looking for in 25 if we can start to see the demand growth. Without that, UPS continues to have Amazon pulling away packages. You had the union contracts that they had to go negotiate last year that caused a huge increase in costs for UPS. So they've been going through a lot of battles without getting package volumes. They did take on a lot of Temu and Shein business. Those are low weight volumes coming from Chinese e-commerce customers that have really exploded in demand, but at very low or negative incremental profit margins. So given that, we need to see demand really increase. We need to leave this freight recession behind, get those volumes to come onto the network. And in the meantime, UPS last quarter, what we saw was them dive in just like FedEx and start to pull out a lot of costs. So they are, in the midst of this downturn, doing what they need to do to get their costs aligned. But again, what's going to take that turnaround is really going to be the volumes. We think, again, that, if we start seeing a slow increase, certainly we've got an administration that wants to come in, deregulatory policies, you got lower tax rates, all these things that could encourage small, medium-sized businesses to make investments and get some growth. That would be what would be driving the incremental margin flow for companies like UPS.
Ken, just lastly, you mentioned the incoming administration. It seems like there is a brouhaha that's brewing right now with regard to USPS. What does that net out for the transportation sector and some of the names that are under your coverage?
Well, the administration floated the idea of potentially, making an independent, completely independent organization. Right now, it is an independently run organization within the government, but that does mean, ultimately, if there are losses, they are somehow funded by the taxpayers. So if we're going to spin them out, it could mean you're seeing an organization that's much more focused on pricing, getting pricing to align with where their costs are, trimming some services that are not necessary. Obviously, we've seen first-class mail really get decimated over the past decade, and with that, trying to use small package businesses to compete in the market, to compete as a business. So, but if you bring those pricing up as the low-cost provider, you'll be lifting the tide for UPS and FedEx to be able to raise rates as well. Now, there still is another competitor out there with Amazon, but again, if the Postal Service is left as an independent organization and is forced then to raise rates even further, it should be beneficial to the outlook for UPS and FedEx. But that's a long road ahead for the post office to be spun out, but certainly something we've seen on a global basis in different countries.
Ken, appreciate your time in those stock picks. Thanks for joining us.
Thank you. Have a great one. Happy holidays.
You too. In 2025, weight loss drugs are facing new applications, changes to insurance coverage, and a wary investor base. Here to break down what the new year could look like for GLP-1s, Anjali Kamlani. Anj.
Yeah, you guys know that, of course, GLP-1s have been a hot topic for the past couple of years, but we're getting into a new phase for the industry, in part because we've seen an increase in the coverage through employers and commercial insurance. Questions about whether or not the companies, mainly Novo Nordisk and Eli Lilly, can skirt some of the rules that couldn't sort of stop the insurers from covering for weight loss specifically, and can move into other spaces. So we're looking at new areas of disease coverage, including heart disease and sleep apnea. Those are the two front runners. Novo Nordisk already successfully got that first one in the bag, and so they have opened the doors for coverage there through Medicare and Medicaid. Meanwhile, kidney disease, liver disease, and newly alcoholism or addiction is something Eli Lilly is pursuing now, and announced that it would be its next focus for the upcoming year. So we'll have all eyes on what those clinical trial results look like. Meanwhile, as I mentioned, an increase in that coverage. Commercial and employers had about 24.4 million. Meanwhile, the government side between Medicare and Medicaid shared the bulk of coverage that we've seen increase in the past year, 52.2 million covered lives there. And so that has really put the pressure on the government to decide how to move forward. We know with a new incoming administration, questions around what kind of support they will get and whether or not the rules and the obstacles against weight loss coverage will be removed. That's something we're waiting to watch. Meanwhile, what else is out there for this area? We know that there's been a lot of hype behind it and a lot of interest from not just the healthcare investors, but also general investors. And will that come to a peak? Are they tired of it? And will we have reached an efficacy point of the weight loss that maybe no one is interested in anymore, and there is sort of a usual flow of business? That's something that remains to be seen. Mizuho's analyst, Jared Holes, did tell us earlier, or rather in a note, did say that, quote, we're going to be seeing this entire obesity category remain intriguing for all of healthcare because of the market size. And there's no doubt that future data sets will continue to reshape thinking on how the treatment regimen's involved, and where these companies and stocks are going to be positioned. We know that Amgen and Viking Therapeutics, for example, are the two nearest in line to compete. So all eyes on there. We'll have to watch.
Absolutely, we will.
On your
Anjali,
head.
we know you will be as well. Thanks so much. Sticking with weight loss drugs, following disappointing clinical trial results for CagriSema and then BMO cut its price target for Novo Nordisk to $105, down from $156. Evan Siegerman, who is the BMO Managing Director of Biopharma Equity Research, joins us now. Always love a good healthcare pronunciation and biopharma pronunciation to send me into
Thanks, guys.
the holiday weekend here,
Yes.
or at least the break here. Ultimately, as you kind of look across your assessment of Novo's own solutions, that they're looking for more of the clinical trial and positive results around, how are they set up going into 2025?
Great question. I think it's important to review what happened last week. We had the CagriSema data, which you had mentioned, and frankly, it fell short of the expectations that the company put out. They said they wanted to see 25% weight loss. They posted 22.7. And in this game, every percentage point matters. I think the tolerability of CagriSema was also in question. So what does it look like going forward? First of all, this was supposed to be Novo's answer to tirzepatide and retatrutide, some higher efficacy drugs. And it kind of feels like we're no man's land here. So we're really focused on next year when it comes to 4 key results. That's going to set the tone for the commercial side of these products for both Lilly and Novo. And then mid-year for Lilly, we have orforglipron, which is their small molecule pill GLP-1, which could really open up the market. So I feel like Novo is kind of losing its pep a little bit.
But you're still bullish on Novo, right?
Not as bullish as I used to be. And I'd like to note that in our outlook, we actually took Lilly and Novo away from our top picks, focused more on names like Vertex. So we still like them, and I think the reaction last week was a bit overdone, but we cut our price target significantly.
What does it mean that you have an incoming administration as well and cabinet selects that could perhaps toss a lot of cold water on the advancements that we've seen and a lot of the demand that's been thrust towards GLP-1s?
Well, I don't think the demand changes because the consumer is the consumer regardless of an administration. When it comes to RFK, a lot of talk. I think when he maybe gets into HHS, he's going to realize that it's a very complicated organization and to effect a lot of change is very difficult. I am focused on Dr. Martin Makary, the potential FDA head, who I think could be good for industry. He's been a little controversial at some points, but overall has been supportive of the drug industry.
Well, Evan, RFK Jr. has made his feelings about GLP-1s well known, right?
Yes,
not a fan. If he did get confirmed, and we've had analysts on the show who actually worked at HHS, and they think it could be difficult for him. But even if he did, Evan, what could he actually do in that role to have an impact?
It's a great question. He could. I think the first thing he could do would be make it more challenging for Medicare to cover GLP-1s for things like heart disease and sleep apnea. That's a big hypothetical because, again, it's a lot of bureaucrats making those decisions. He could also just put pressure on FDA, be a little more, cautious in your, approval. But again, I don't think he's going to do that. So that's hypothetical that I'm speaking. I think he's more focused on food dyes, and just healthier living for whatever that means.
Do you think that we see any significant headway in the costs of healthcare tackled? Especially, and I know that that's multi-pronged too, because we're talking about everything from health insurance to the cost of drugs itself. And so where is the easiest or maybe lowest hanging fruit for that to be tackled?
So I actually think some PBM reform could help because PBMs, as we know, are kind of driving up the list price of these products because they like their rebates and discounts, and to get a bigger rebate and discount, you get a higher list price. So we didn't get any of that in the year-end spending bill, but maybe next year we get some action there. I also think that just for what it's worth, Lilly and Novo, the net price of these products is coming down as more insurance companies cover them. So I think it's about the out-of-pocket costs. I'd like to see more accessibility. That also comes with more supply. But I really think PBM reform is what could affect cost, especially for drugs, most significantly.
Do you put pen to paper, Evan, try to figure out, okay, this is how big I think the GLP-1 market could be in 5 years, 2030?
We've talked about that on this show, I believe.
I should remember.
I know. I think we're at about 150 billion plus across all players. Most of that's in the United States. It could grow. The way I think about it that's important though is it is a volume game for these companies, which is why Lilly and Novo are poised to win because they have the capacity and ability to supply these markets. So over time, the net price per patient goes down, $300, $400 per patient per month, but you have many millions on drug.
You know, it seemed like all of us became experts in messenger RNA over the course of the pandemic, and now many of those names, for the pullbacks that we've seen, and now analysts trying to re-rate and understand what type of platform additive that will be for the bottom line. Is there any clarity in sight on that now?
So I cover Pfizer, we'll talk about it from that perspective.
Sure.
I don't really see them doing much with mRNA. It helped us in the pandemic, but their latest vaccine for RSV is a traditional protein vaccine. So I actually think for a lot of the vaccines going forward, that's where we want to be. Maybe with some personalized cancer vaccines, but that seems to has not gotten as much traction as we would have hoped. And when you look at some of the Moderna vaccines for RSV, for example, they've been disappointing.
You have, in your coverage universe, you only have one lonely cell.
Yes.
It's one lonely underperformer. Insight.
Insight.
Ticker INCY.
Yes.
Why? Why is that a sell, Evan, as we head into the new year?
Yeah, we downgraded Insight back in June because the company decided to buy back $2 billion of their shares versus investing in the pipeline. And I've covered this company since 2015 or so, and I've always been disappointed with how they managed their pipeline. Most recently, they had a blow-up from an acquisition that they bought. And my concern is that as we come towards 2028, the LOE for their big drug Jakafi, it's a pill, they don't have anything to replace it. And that's when you see multiples compress, that's when you see people dump the stock. So I need an answer to that pipeline because that's how biopharma thrives.
Evan, always great to see you, have you on the show, and have you here on set.
Yes.
Appreciate it.
Happy holidays, everyone.
You too.
Happy holidays.
Coming up, a look at what we can expect from the Federal Reserve in 2025. The Federal Reserve avoided a recession in 2024, making its way toward an economic soft landing. Yet, much like at the beginning of 2024, Fed officials ending the year still worried about inflation. While looking ahead to 2025, uncertainty under a Trump administration hangs overhead for the central bank. For more on the next moves for the Fed, we have Serpa Pinto Advisory founder John Hilsenrath. John, always great to see you and have you on the show. Interested, John, is I haven't heard your take yet on the Fed and the recent moves they made. They cut, John. They signal fewer cuts ahead. Is that what you were expecting to see, John? And in your opinion, was it the right move?
It was what I was expecting, and I think it was the wrong move, to be honest with you. The inflation, the improvement that the Fed was making on inflation slowed down in the fourth quarter. The economy proved to be stronger than the Fed expected in the fourth quarter. And we're heading into an environment in 2025 where there's inflation risk from tariffs, from deportation of potential workers, from tax cuts, deficits. So I think that the Fed waited one meeting too many to pause the rate cut cycle. They effectively announced they were in a pause mode for 2025. I think we're going to have to see real tangible improvement on inflation before they cut rates again. I don't think it's going to happen in the first 2 months of the year, maybe by March, but I'm not expecting that.
John, I was looking at your notes, and My Chemical Romance over the past few days here has really been looking at the balance sheet and trying to get some sense of what's going to take place there. And I'm glad we're in alignment on this because of the decisions that are coming due there and the pace at which, and here you're taking a look at the Federal Reserve's balance sheet over the years and the pace at which they will be unwinding this even more. What are your anticipations there? How much more priority might this take versus some of the decisions whether or not to cut or hold?
Well, I'm really glad you asked about this because I don't think that the balance sheet has gotten enough attention in the last few months. We have to take the decision about the balance sheet apart from their decisions on interest rates. But the Fed has been winding down its balance sheet, and they've kind of been telegraphing that the pace of that wind down is going to slow this year in 2025. And the economists that I've talked to are expecting the Fed to the balance sheet to reach this steady state of a little more than $6 trillion in 2025. But the Fed has deferred a really important question, which I see as a risk to the bond market. So they're going to stop winding down the balance sheet in 2025. But what really, really matters isn't the size of the balance sheet. It's the construction of the balance sheet. It's what do they hold in mortgage securities? And most importantly, what do they hold in long-term Treasury securities? They've wound that down, but they still have around more than $6 trillion of Treasury and mortgage security, of long-term Treasury and mortgage securities on their balance sheet. And they have to make a decision about whether they continue to wind those large holdings down by moving them out of long-term securities and into bills. And if they do that, then that could put upward pressure on long-term interest rates in the coming year, in particular when they make the announcement. They haven't said what they're going to do. They had debates about a strategy like this back before COVID, and Powell in those debates suggested that he wanted much fewer long-term treasuries on the balance sheet. If they do that, that means more long-term treasuries in the private sector's hands, which could put upward pressure on rates.
John, you mentioned Powell there. I'm just curious, how do you potentially see the relationship evolving from here over the next year between Powell and President-elect Trump?
Well, so, Powell's playbook during the first term was to tune out the president's criticism of his action and the president's threats, and to stay focused and to say he was staying focused on the economy. I think the temperature is going to be turned up for Powell because the Fed is in a pause mode. We don't know how the president's going to feel about that. And also because if inflation doesn't get down to that 2% target, then this new president might be looking for someone to blame for sustained high inflation. And the man is going to be sitting right in front of him. It's going to be Jay Powell. So I think there's going to be discord, and Powell is going to keep his very stoic tone and try to tune it all out. Let's not forget, Powell's term is up in a couple of years. I think, frankly, that he can't wait to be done and to head off into the sunset.
Yeah, I'm sweating just thinking about the temperature being turned up between Trump and Powell, especially come January here. John, just lastly, who do you think is most likely, especially as you have other positions and you're going to have some changing of the voting members as well coming forward? Who is Trump most likely to try and put in any of those new and open Fed positions in order to then potentially fast track them into being the next Fed chair?
Well, let's talk about the Fed chair. And actually, frankly, for the governor positions, too. What we've learned in this cycle of nominations that the president has made is that you really don't know. It's really a moving target. So I'm going to start by saying that. I don't know. We can give you a list and we could do our guessing. But it's the two Kevins that people often talk about. One is Kevin Warsh, who got an interview with the president. Former Fed governor, got an interview for the Treasury Secretary job. The president has now passed over Kevin Warsh 2 times. The other Kevin is going to be sitting right next to the president in the White House, and that's Kevin Hassett, who is the chair of the National Economic Council. And I've got my eye on Kevin Hassett. Kevin Hassett worked as a Fed staffer decades ago. He ran President Trump's Council of Economic Advisors in his first term. He has a close working relationship with him, and he has some comfort level with working with the president. Some might say managing the president. So I think Kevin Hassett is a guy we have to keep a close eye on.
John, we are always lucky to have you on the show. Thank you for joining us.
Next time, I hope to be right there on set with you guys.
I hope so too, John. Happy holidays.
All right, thanks a lot. Take care.
Well, wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That is the closing bell on Wall Street, and now it is time for market domination overtime. Taking a look at the bell ringers here on the day, you've got a live look at the Nasdaq and at the NYSE. And we got to check in on the results for the first day of the Santa Claus rally here. The S&P 500 doing its legwork. That's up by about 1.1%. That's where things end on this abbreviated trading session. You've also got the Dow. So pitching in by about 0.9%. And then the Nasdaq Composite also pitched in about 1.3, 1.4%. If you want to round that off at home, nobody would fault you. They'd say Merry Christmas to you. Why not? And Happy Holidays plus Happy Hanukkah. All right, let's take a look at some of the heat maps here. We heard you like maps, so here's a heat map. Taking a look at the Nasdaq 100, you've got to look at the mega cap tech stocks right now. Apple ends the day higher by about 1.2%. Nvidia, Microsoft, Amazon. It's almost like the Full House theme song everywhere you look, except for a few of these red spots on the dial here. But also taking a look at the Dow Jones Industrial Average, just a brief gander at how things ended. Looks like only 3 of the 30 names end in negative territory. Nike, one of them here. We've been watching a little bit of a pullback here, and I'll give you a little bit more context, especially on the year-to-date side. We've been tracking this lower by about 29%. You've got a lot of factors at play there. You've got a new CEO we just heard from in recent weeks here after his first quarter, Elliott Hill. We'll see what more is to come in that turnaround story for the stock as well. And we'll see ultimately how the rest of some of those big retail names move through this holiday season. Of course, for those of you shoppers who are out there doing your last-minute spending here, we'll just take a brief look at some of those retail names as I'm seeing them here on the day. Final heat map for you. We're seeing a lot of green on the screen. Josh, over to you.
Thank you, Brad. An early Christmas gift on Wall Street. Stocks closing near the highs of the day. And our next guest has some sectors to consider that are outside of big tech, which has driven, of course, a lot of the market's gains this year. And joining us now is Eric Sterner, Apollon Wealth Management Chief Investment Officer. Eric, it's good to see you. So you're telling your clients, Eric, you would be a fan here of a slight tilt towards certain areas of the market. Walk us through what those areas of the market would be, Eric.
Yeah, well, happy holidays, and thanks for having me on the show. I certainly think that we are still in the early innings, so I think there's always room for technology in the clients' portfolios. But the good news is with this rally, as we're starting to see, it's broadening, and it's adding sustainability to that rally. And earnings growth next year, you look at the tech earnings, it's expected to grow 21%. While the rest of the market, or I should say the top 10s, the Magnificent Seven are expected to grow 21%, while the rest of the stock market is expected to grow 13%. So we're seeing that narrow, and we see some other sectors that have more attractive valuations. And some of the sectors that I really like right now, I continue to like healthcare. That's actually expected to have the second highest earnings growth rate in 2025. Obviously, a lot of innovation and excitement with the weight loss drugs. I mean, they're expected to have annual revenues anywhere from 80 to 140 billion annually by 2030. And then you look at some sectors that have been beaten down by these higher rates. We know the Fed has cut 100 basis points already, and they'll continue to cut next year, probably a slower pace than some investors would like. But industrials and materials, respectively, they're supposed to have, or are projected to have, the third and fourth highest profit earnings growth rate in 2025. And we know Trump is going to try to bring a lot of manufacturing jobs back to the U.S. That's a trend that has been happening for the past few years. And the number of data centers is expected to grow 50% by 2026. So I think we're as the Fed slowly reduces rates and we see a more pro-business environment going into 2025, we could see some stronger returns out of these other sectors that some investors may have shied away from over the past 2 years.
Yeah, Eric, I'm taking a look at some of the sectors that led the charge on this, the first day of the Santa Claus rally, and consumer discretionary, financials, technology really leading the pack, communication services, I'll throw them in there as well. As you think about what this Santa Claus rally could signal about some of the outperformers going into and beginning next year, what does that really tell you about where investors are going to continue to pile in, even if a trade might be overcrowded?
Yeah, we've seen, we saw that broadening in the market between some of those sectors I mentioned, more value-oriented sectors, and even small caps. But lately, tech has reclaimed the lead, and I think some of that is the uncertainty. Trump has made many bold statements and has caused some inflation concerns amongst investors between tax cuts, limited immigration, even deportation, and of course the tariffs. So I think as investors are trying to determine which of those bold statements will result in policy change, sometimes they flock back to those megatechs because megatechs can act as defensive plays because they have such strong balance sheets, such strong earnings. So I think that's why we're starting to see some of that investors going back there, especially with the Fed projecting less rate cuts next year. Remains to be seen. I mean, they reduced it from 100 basis points in the dot plot from September to 50 basis points with the dot plot last week. But I don't think we should have been surprised by that because Powell doesn't like to surprise markets. He was certainly giving us plenty of hints leading up to the Fed meeting, talking about the strength of the U.S. economy has lessened the urgency to reduce rates. So to answer your question, yeah, I think some investors might be leaning a little bit more into tech until we figure out which of Trump's bold statements over the past few months result in policy change and what these tariffs are going to look like.
Speaking about bold statements, Eric, I mean, certainly Trump has made a lot of bold statements about cryptocurrencies. I know you're not a fan, Eric, but you look at President-elect Trump, he's a fan. And in fact, so many around him, J.D. Vance, RFK Jr., Howard Lutnick, these are all fans of cryptocurrencies. What would make you more bullish, Eric, about that space?
I just think it's still very early within crypto. I know they've been around for a number of years, but the volatility is just off the charts. And they don't produce income. They really don't provide the diversification that they sometimes talk about. One of the benefits of cryptos, they don't really provide the true diversification that I see with stocks and bonds. And there's just thousands and thousands of cryptos. I don't know if anyone knows how many cryptos are out there. I've heard estimates from 9,000 to 20,000. So it's a very saturated market. I think it still needs some time to stabilize. Certainly, a lot of those cryptocurrencies are not going to exist in a few years. I mean, obviously, Bitcoin is the leader. I think it's safe to say Bitcoin will be around. But just due to the volatility and the lack of regulatory framework. And we saw the SEC working its way towards that. And now with Trump in office, we may not see that framework in place. I'd like to see that framework in place just to protect investors, because right now I just view that as a speculative trading. So if you want to take a chance and put some money in crypto and let it ride, sure, go ahead. But if you want a true diversifier for a portfolio, I'd rather put gold in my portfolio because gold's track record is several centuries longer than crypto. And I think we just need to see the cryptocurrency just market in general see less in volatility, and then we may see whether it has a true place in a diversified portfolio.
Oh, come on. Then it wouldn't be a risk trade. Eric, thanks so much. Appreciate it. Incoming FCC Chair Brendan Carr is wasting no time getting down to brass tacks with some of the major players in media. According to CNN, Carr sent a letter to Disney CEO Bob Iger over the weekend. Yahoo Finance's Alexandra Canal is the Disney whisperer and has all the details. Hey, Ali.
Hi, Brad. Yeah, and just to backtrack here, ABC, which is owned by Disney, settled a defamation lawsuit filed by Donald Trump over comments made by anchor George Stephanopoulos back in March. Now, the network paid $15 million to Trump's presidential foundation and library, in addition to $1 million in legal fees. So this letter that Carr sent to Iger, which was obtained by CNN, specifically referenced that settlement and a distrust in the media as a result. Experts have said there are escalating fears that this settlement could lead to other Trump lawsuits and further attacks on the media. So something to certainly watch as he takes office. Carr, meanwhile, said in the letter that local media outlets have higher levels of trust, which is not all that surprising considering Carr's background. He's long advocated for deregulation in this space, an intent to revisit ownership caps. That's likely to spur more consolidation within local and broadcast television at a time when many of these companies are really struggling to compete with big tech. So think companies like Nexstar Media Group, which controls the CW network, along with Fox television stations, Sinclair Broadcast Group, Gray Media. All of these are corporations that are looking to purchase more TV stations in order to better compete with big tech. Carr is a big supporter of local news. He says that policies need to empower these stations, even if it's a conflict of interest at the national level. So judging by what we're seeing with this letter, judging by Carr's nomination as FCC chair by Donald Trump, I do expect that we will see more media M&A in the future, along as potentially more tensions between Trump and the media landscape at large. So a lot to keep track of in 2025.
All right, thank you, Ali. Appreciate it. AI and its impact on mega cap names like Nvidia has been the talk of Wall Street throughout 2024, but the best performing stock on the S&P 500 isn't a tech company. Still, it has everything to do with AI. Power generator Vistra Energy shares have soared more than 250% year to date. That's thanks to surging power demand from AI data centers. Despite that stock's record run this year, George Schulze Asset Management founder, sees far more room for the stock to run.
We expect Vistra Energy to rebound going forward as we get more fundamental news. This is a utility holding company. It operates in 20 different states across the nation, selling electricity and also generating electricity in numerous markets. Its predecessor, a company called TXU, restructured in bankruptcy in 2016 after eliminating $40 billion in debt. And separately, in 2012, its Dynegy subsidiary also restructured in bankruptcy after eliminating $4.4 billion in debt. So the company combined has a really clean balance sheet. Earlier this year, it acquired Energy Harbor, which added 4,000 megawatts of nuclear power generation capacity and made Vistra one of the largest zero carbon generating platforms in the United States. And just regarding the electricity market in general, electricity generation had become a pretty mature industry, but it's growing now because of new electricity demand from data centers and electric vehicles, and also from hyperscalers like Amazon and Microsoft, who are signing new electric supply agreements. So we think there's a lot of upside potential for Vistra.
2025 promises to bring some major changes in the tech sector, from a possible ban of TikTok to policy shifts under a second administration for President Trump. Joining us now, we've got Adam Kovacevic, who is the Chamber of Progress CEO and founder. Adam, great to have you here with us today. So as you think about some of the many changes, especially as it's related to tech, what is at the top of your list of expectations?
Well, I think one of the good pieces of news is that President-elect Trump has appointed a number of people from the tech world, venture capitalists, people with tech experience, to prominent positions. And, look, I didn't support President Trump, but I think that's a good sign. I think there's been a lot of frustration in the tech industry that the Biden administration spent more time trashing the U.S. tech industry rather than championing it. And to have people come in from the industry, I think, is a good thing. This is what President Obama did. And honestly, he had better tech policy and higher ratings on the economy than Biden did. So I think that's a positive with respect to setting a good tone. I also think there's a number of things that the Trump people are going to do when they first come in, unwind the Biden executive order on artificial intelligence, change direction at the SEC on crypto policy. I think those things will be positive for the innovation economy as well.
It's interesting, though, Adam, because Trump seems to almost sort of distinguish and delineate between big tech and little tech. He likes, in his words, little tech. But big tech, he does not have very nice things to say about big tech, Adam. I mean, when he nominated Gail Slater as head of the Justice Department's antitrust division, he just goes off on big tech, that it's run wild for years, it's stifling competition, it's using its market power to crack down on the rights of so many Americans. What do you make of that? I mean, what do you think that could mean in terms of actual policy implications and ramifications?
Well, I think we have to look back to his first term, where I actually think the reality was a little more complicated. There were issues, for example, where he picked fights with the European regulators to help American companies and said, hey, wait a minute, we don't think you should be taxing American tech companies unfairly. We don't think you should be regulating them unfairly. And there were tech CEOs, who I think successfully got Trump on their side in some of those fights. On the other hand, his administration brought antitrust cases against Facebook and against Google. I think the reality, though, is that Trump doesn't particularly care about policy issues like antitrust. What he really cares about is this company nice to me? And I think what he's driven by is, is this a company that's actually helped me? For example, earlier this week, he gave a speech in Arizona and talked about TikTok. And the way he talked about TikTok was he said, well, the TikTok executives came in and showed him a chart about how well Trump had done on TikTok during the campaign. And so therefore, we should keep TikTok around a little bit. It's kind of begins and ends with how he feels the company is treating him personally.
Yeah, sort of kiss the ring moment that we're seeing kind of play out here. And ultimately, we've had a lot of major tech companies try to insulate themselves from any type of directed turmoil towards their company coming from the Oval Office, come the inauguration and anything thereafter from Trump. All these things watched and considered here. We've seen breakout stars emerge in artificial intelligence. How much of a continuation of that do you anticipate, knowing where Trump has also aligned some of his own interests and talked about technology more broadly?
Well, I think you hone on a great point, which is the area of artificial intelligence. Look, the Biden administration, its main approach to artificial intelligence was to say, this is an area where we ought to tread carefully and put up guardrails and focus on safety. Now, of course, safety is in the eye of the beholders. What I think you are going to see with Trump is a pivot from safety to really AI as a economic asset for the United States, a national asset for the United States, where we should go out and beat other countries, particularly China, in AI. And, one of the things I think we see happening, for example, the Chinese government is exploring antitrust cases against Nvidia. Why? Not because there's a real legitimate antitrust issue there, but because they want to punish us, right, and bring that into a trade war. So I think that it will be a welcome pivot from the industry to see the administration say, no, AI is an industry that we want America to dominate and an area where we want to, frankly, kick other countries' butts in.
Sticking with AI, Adam, any thoughts on David Sachs, Trump's pick to be AI and crypto czar?
Well, he has, as a venture capitalist, he's invested in a lot of AI companies, right? So I think he's seen from, really like up close perspective, like what it means to start an AI company. And I think that's going to be a valuable perspective. I do think it's helpful to have more of an investor startup perspective coming into the administration, because have not been a lot of people, again, in the Biden world who've like actually started companies and seen that up close. So I think that can't help but be a positive thing.
Adam, great to see you and have you on the show today. Happy holidays.
Thank you.
We'll be back after this break, but first, a look at some New Year's resolutions for investors.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO, you want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes, is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano. and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
Time now for what to watch Wednesday, December 25th and Thursday, December 26th. A reminder, markets will be closed tomorrow for Christmas Day. Trading and maybe that Santa Claus rally will resume Thursday, December 26th. This after stocks closed at the highs of the day on Tuesday.
Thursday will also bring a new batch of labor market data. Initial jobless claims for the week ending December 21st, due at 8:30 a.m. Eastern. Claims are expected to rise slightly. 223,000 is the figure that we're anticipating after falling in the week prior, and it's all quiet on the earnings front with limited releases during the holiday-shortened week.
And while markets won't be open tomorrow, Christmas Day will be a major test for Netflix. The streaming giant will air 2 NFL games for the first time ever. The Kansas City Chiefs face the Pittsburgh Steelers at 1 p.m. Eastern, followed by the Houston Texans and the Baltimore Ravens at 4:30 p.m. The 2 games, along with live performances from Mariah Carey, Beyonce, and others, will be a major test for Netflix as the streamer attempts another foray into live sports. Its broadcast of a Mike Tyson-Jake Paul fight last month drew 108 million global viewers, but was hit, we know, with technical issues. Tomorrow will be another test for both football fans and investors.
That'll do it for today's Market Domination Overtime. Be sure to come back Thursday, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell.
And happy holidays.
Ho, ho, ho. Ho, ho, ho.